Today we are going to study hedge funds. And after the end of this class, you will feel that you have become smarter, significantly smarter. So normally hedge fund managers, they are not traditional investors or traditional managers. They come with their own unique ideas, and often it is smarter. So when we look at their logic, try to understand that, we learn something from them. Now, whether they will succeed or not, that's different issue. Because succeeding in a financial market is somewhat difficult, very difficult, as well as a matter of luck as well. And so far, though the CFA book says that the market is semi-efficient, and our analysis says that the market is not even weakly efficient, because many technical analyst people have made money on a consistent basis. Means it is not that every day, but if they invested for 10 years, they ended up becoming rich. And secondly, there are taxes, then transaction costs, and rules for insider trading. Means some insider trading is also happening. Otherwise, there is no point in having rules, or the rules are there and still they are violated. So people get punished, people get what I would say caught doing insider trading. So if there are transaction costs, if there are this insider trading, and if there are taxes, then it is difficult for the market to be even weakly efficient. Because whenever we study demand and supply, and the perfect competition market is most efficient, so we feel that there are no taxes, there are no okay. And another factor which is making the market inefficient is illiquidity. However, in the exam you will write market is semi-efficient, okay. And hedge funds are also there. So these hedge funds try to exploit inefficiencies in the market. If there are no efficiencies in the market, then as the as this efficient market hypothesis tells, that from public information nobody can make money if it is semi-efficient. And if it is efficient, then even insider information, with insider information also, nobody can make money. But hedge funds are making money. They have made money in the past, and they have made more money in the long run over equities and definitely over bonds. So now it doesn't make sense if I say that they made more money than bonds, because bonds are lower risk. So if I say that hedge funds have made more money on risk-adjusted basis than bonds, then I can say that, yeah, okay, I have made it in my statement, because I have adjusted risk and return. Otherwise, equities are making more money than bonds, it's for sure. Historically, it has been proven, but then equities are getting risk premium. It is not that equity investing is more investment, it is that they are more risky and they are getting risk premium, and that risk premium is converting into extra return. So if hedge funds have given extra return and risk also increased, then it is not going to add anything to our investment strategy. Means we can simply double our equity investing, which will double the risk as well, or we can do leverage investing, which increases the risk. Then we can get the same return as hedge fund. Then why should there be any hedge fund? But that is not the case. Hedge funds have reduced the risk and increased the return. Then only we are getting free lunch, or we are getting diversification benefit when they are not correlated with equities or bonds or both. So that's why the hedge funds, it has been found that most of the hedge funds have low correlation. So they provided diversification benefit, and then they had higher return as well. So they increased the return also. So we will study today uh, what hedge funds are and what are the strategies of hedge funds, that is making them a separate strategy of investment. They are not a class, like real estate is a class, natural resources are an asset class, so they are not asset classes, but they they invest also on public equities. Most of the hedge funds invest on public equities and public bonds, or government bonds and corporate bonds. So they are investing in public equities, unlike private equities, because private equity invests in private bonds and private equities. But hedge funds invest in both private as well as public equities and bonds. So, or well, they invest in other asset classes as well, that they may invest in natural resources, they may invest in private equity also. So they have the least regulation. So that way, though they are not a separate asset class, but they provide diversification benefit and increase higher return benefit because of their unique strategies. So which are those unique strategies? We will study here, and then we will know how hedge funds have added value to portfolio management or to this uh, financial world. So let's start here. We go to the part two because we will come back here again. And these are hedge fund investment features. So what is the objective of hedge funds? So hedge funds are distinguished by their investment approach rather than the underlying investment, because underlying investment will be the same: equities, bonds, commodities, foreign exchange, and even real estate, private equity, natural resources as well. So they will be investing in the same asset classes, but their strategy will be different. And it is this different strategy which will make you smarter today. You will learn that, how they have how they have beaten others, and if they have beaten others, means they are smarter. So let's see, and that's why it
Sir,
is.
can a multi-asset allocation mutual
Yes,
fund be considered as a hedge fund, sir?
no, definitely not, because of two reasons. Mutual funds are highly regulated, and then the manager of the mutual fund is not obligated to invest his assets in the same mutual fund. He may invest in another mutual fund, or he may invest in hedge funds, or he may invest
Oh,
somewhere else he likes. So, and then mutual fund managers don't get any performance bonus; they get their salary. So, mutual fund managers and ETFs are far less regulated than mutual funds, but still they are much more regulated than hedge funds. So they are not, and they are not paid performance bonus. So neither ETFs nor mutual funds are hedge funds.
okay, sir. Okay. So the
Yes.
main difference is the manager also has to invest in the same fund, whereas in mutual funds they do not.
Yes, mutual fund and ETF, the manager doesn't have to invest in those funds. So that way uh, the the
Accountability increases.
yes, yes, that way this is aligned, means the manager's interest and investors' interests are
Oh,
aligned.
the principal agent problem is removed.
Yes,
Okay.
that's right. Principal agent problem is removed, or at least solved
Okay.
to a big extent. And then regulation also. That hedge funds are least regulated vehicles of investment. They don't have to give daily return, monthly return, or quarterly return. So, like private equity, they don't have to give any financial disclosures. So that is
Then would it be annual return only? Like while they file taxes,
uh,
only they'll have to do.
it is not required by law. If they give, it is their privilege, and if they are giving, they might try to attract other investors. So they are giving their return. They may give monthly return also.
Sir, but
But
like on the profits they need to pay tax now, sir. So somehow they like somewhere they'll have to disclose it, right?
oh, when they have to pay taxes means that will be just their income statement if they are in the tax jurisdiction. What if they are in non-tax jurisdiction? Like in Gulf countries, there are no income taxes, or
Oh,
in Cayman Island also there is no income taxes. So there they don't have to even disclose anything.
oh, oh. So that's why most of these are registered over there, and
Yes,
okay,
yes, they try to save taxes.
okay.
Means, so here it is.
Sir,
The objective,
but in mutual funds also the manager gets some performance bonus now, right?
no, he doesn't get. He just gets salary.
Oh, so then he will not have much incentive to get extra returns.
Yes, sir. And he's not supposed to do more risky investments. He's supposed to do as per the objective of the mutual fund. So
Oh,
where he will invest, it is already given in the mutual fund.
oh yes, sir. Okay, okay. In the first advertisement they give, and they give that risk meter and all, and they'll say the 70% in this, 30% and 20% in that.
Yes, that's
Okay,
right.
okay,
So
okay,
they already describe it where in hedge funds there is no such limit. They can invest anywhere they like.
okay, sir. Okay, okay.
Yeah. So the objective of a hedge fund is to generate high return either in absolute sense or on a risk adjusted basis relative to its portfolio level volatility. So portfolio level volatility is the risk. So if they are generating more return and risk is the same, then hedge fund is doing better, or at least they have to match the they have to what give more risk adjusted return, or that is called Sharpe ratio. So what do they do? Thus, many hedge funds evaluate their performance using an absolute standard instead of tracking a benchmark. They don't have a benchmark because their strategies are different. Though some benchmark is published, but that is not for all the hedge funds because they have different strategies. So there are basically 5 classes of hedge funds strategies, and we will discuss each of them. So they don't have clear benchmark, and then we had earlier also studied that the index, hedge fund performance index, is beset with the problem of survivorship bias and backfill
Backfill,
bias.
backfill bias. Okay.
Yeah, and there is one new bias here, selection bias. So
Oh, okay.
selection bias happens when uh, the hedge fund, since it is voluntary, himself selects that, okay, I will post my uh, returns or performance in this index. So that way, since he has himself selected, means it is selection bias. Selection bias won't happen when everybody is selected. So who will select himself? The one who is performing better than others. Only he will select to be represented in the index so that he can get more funds for investment. So that way there is, and some these index providers also say that okay, minimum amount of asset management means minimum 100 million of asset management only they can enter into this index. So that way also there is selection bias that smaller hedge funds may not be part of that index. So there are 3 problems in hedge fund indexes: survivor bias, backfill bias, and selection bias. Mm. Okay, now hedge funds, do they really hedge their risk? It looks like they take leverage, they use derivatives, and then they borrow as well. Then they invest in illiquid items also. So that it looks like that they are increasing their risk. But when we see the content of the portfolio, means if the portfolio is containing what bonds, equities, and real estate as well, or what currency also, because it may be of different countries. Then in that case, they have those asset classes in their portfolio which have correlation less than one. Like equities and bonds have very low correlation. Same way, we saw all alternative investments provide this diversification benefit. So when hedge funds are investing in alternative assets as well as in bonds as well as in equities, and yes, private equity also has low correlation with public equity. So that way the portfolio risk is reduced or portfolio is hedged, even though the hedge fund himself looks like increasing the risk because it has taken leverage mm, or used derivative investment or had made investment derivative, and derivatives are far more riskier than equities or bonds. So that way, hedge fund name, it may sound misnomer, but actually some risk is hedged. Okay, and I already explained that
So,
how.
so is it like the risk of a derivative is hedged by investing in another asset class, and the risk of that other asset class is hedged
Delta
by
ratio, yes.
oh, oh
Yes, that can that we had studied when we were doing this binomial model calculation or
mm,
this risk management. Then we had calculated the delta of the derivative, and on that basis, if it was put and derivative, then both were purchased. Means the put was purchased and the derivative was put is derivative, and the underlying stock was also purchased.
which is yes.
But in call, it was opposite. That when call was purchased, then underlying asset was sold, or when underlying asset was purchased, the call was sold. So that way there was inverse hedging relationship between call and underlying assets, while it was direct relationship between put and the underlying assets. So that way, the use of derivatives reduces risks, but hedge funds don't use that way. They use derivatives for leveraged performance or leveraged portfolio, such as they use futures, managed futures. The name itself is managed futures. They are not going to buy any underlying, and they will simply buy futures. And futures are very, very liquid. So there is transparency in the price as well as high liquidity in that hedge fund. Hmm. Okay, okay, then okay, so some hedge funds, they will invest on one specific asset class, and then some will combine multiple asset classes. So those who are actually investing in a specific asset class, they are normally controlled by institutional investors, or they are funded by institutional investors to diversify their portfolio. And also their manager is controlled by these institutional fund investors. He doesn't have full freedom. He has, of course, freedom from the regulators, but the institutional investors controls him that, okay, you have to invest in this class, like this asset class, so much percent in equities, 25% in bonds, 15% in REIT, another, not in REIT because REIT and equities are highly correlated, but in real estate, other like real estate fund, and then in currency or all those, they can take together. So let's study. So they are, if they are individual asset class investor hedge fund, most likely they are being controlled by institutional investors. Means those hedge funds are practically working for those institutional investors. So they are not equity managers, but they are hedge fund managers who have far more freedom than equity portfolio manager, because equity portfolio manager has to give reports every 3 months, every quarterly he has to give report. Okay, and those who are doing this multiple asset classes and in multiple geographies, then they will have a more diversified portfolio. Leverage they use extensively, and I already said that. So what are the types of hedge funds? Equity hedge fund. First and most common type of hedge fund is with largest investment. They are equity hedge funds. They will have a lot of equity researchers. Then event-driven hedge funds. So some event happened and then they will make money out of that. Now, what kind of event happens? Corporate event.
Natural disaster. Oh,
Natural disaster is one. Yeah, very good. Natural is an event. Yes. Then
like
corporate
mergers and
event,
acquisitions.
mergers and acquisitions. So what will they do? Okay, we will discuss that now. Okay, I am giving you already hints since you said mergers and acquisition. So what happens in mergers? One company buys the other.
Okay,
Okay,
that is acquisition also.
that is acquisition, yes. Or even in merger also, if even both in acquisition, one is acquiring others.
Yes.
In merger, both are happily agreeing to merge. So
But
basically, there is no difference between the final result. Only difference is that in the acquisition, it is hostile acquisition, then the management will be fired. In merger, the management will be retained because both have agreed. So that way. But end result is that both companies, there will be a bigger company. Yeah.
yes,
Whether it is merger or acquisition. Now, in this process, whose stock falls and whose stock rises? Whenever there is acquisition, so whose stock rises?
if A is merging with A is
B.
buying
A
B.
is merging with B. Okay.
A is the bigger company and B is a smaller company. Then B's stock will rise.
What did you say? Who is getting? Who is buying? Okay.
If
A
A is
is,
buying B, then
okay.
B's stock rises.
Very good. A is buying B, so B is the smaller company.
Smaller companies
So B's stock will rise and A's stock will fall. Okay? So that is event-driven hedge fund. Now, how will you make money out of that?
Sir, by shorting the shares of the big company and longing the shares of the small company.
Okay, so you will short the company of A, you will short the share of A and long the share of B. Okay, very good. So if you are correct, acquisition really happens. Then you are making what? How many alpha? One alpha or two alpha or three alpha? How many alphas are there?
Sir, 2 alpha probably.
Very good. 2 alpha. Because you are getting alpha from the acquirer because you shorted his stock, and if the merger takes place or acquisition takes place, obviously the stock will fall because he will pay higher price or a strategic price to the acquirer. So the 1 alpha you earn from this sorting the company A, and another alpha you earn from this longing the company B. Okay, that's good, very good. So this is a wise step. Means what will the portfolio manager do? They can, since they are not allowed to short, so they can simply buy that stocks of company B. That is what, as an equity researcher, if you are in the mutual fund or if you are in ETF, they are only long only funds. So they cannot short, but they can buy the stocks. Now, so if they have only one leg to invest, then they will make only one alpha, single alpha. So that way the hedge funds are smarter. I mean, they make double alpha while the rest of the world is making only single alpha. What about beta? So what is the beta of this hedge fund?
Beta also will be 2 beta, price the risk.
Beta is systematic risk and alpha is idiosyncratic or individual company risk. So if you are sorting the company of the acquirer, then he has one risk, single risk. Yeah, but when you invest in the entire S&P 500, then
risk is practically eliminated.
Yeah, so you have practically eliminated the single company risk because some will rise, others will fall, and overall you have eliminated the idiosyncratic risk or single risk. Then
So
which risk have
then
you
in this
assumed?
case, beta will be zero. Uh,
Huh?
in this case, beta would be zero.
Beta will be zero.
Zero.
So hedge fund is actually not playing with beta. He is
Oh,
playing
okay.
only with alpha. So
Alpha.
beta of
Okay.
the hedge fund is zero and beta of S&P 500 is 1. Means 100% systematic risk is, means even if you invest in all the markets, all the, then if the entire market goes down because Modi ji did demonetization, or Modi ji did lockdown, then in that case the entire market will down. So even though you eliminated individual risk, you suffered the market risk because the entire market, the stock of all the 500 stocks went down. Well, in India it is in Nifty, so Nifty 50 went down, or whatever, how many, so, or even BSS and such. So all will get down. And if all are going down means you are still bearing the systematic risk, which is called market risk. And market risk is a measure of beta. Now, what happens to this guy, hedge fund? He shorted the security of acquirer company A, and longed the equity of company B. Now Modi ji does demonetization, and all are in equal amount, means both short amount is also 100 crores and long amount is also 100 crore. And Modi ji does demonetization. Then what will happen to the hedge fund investment? Will he lose money or will he not lose money?
Sir, so since both will drop in value, he will not lose money.
He will not lose money because on short he will gain and long he will lose.
Yes.
So that way he is immune from market risk.
Market risk.
So it doesn't matter what Modi ji does. He will, and the rest of the world is losing heavily. But the hedge fund is not losing heavily. So that way, this even different hedge funds, what will he do if it is not an acquisition? But still he thinks that Modi ji is going to do demonetization or impose GST or whatever he may do. Then what will he do? How will he eliminate beta?
So the question is like if the
He
merger is
doesn't
not
know, there is no merger and
happening.
acquisition, but still he knows that Modi ji is going to do demonetization tomorrow. Or, well, he doesn't know when he will do, but since Modi ji does these kinds of anti market friendly measures, stupidities, so how will he save himself from Modi ji? The hedge fund manager. Yeah. Mutual fund manager cannot save, ETF cannot save because Modi ji is the boss. But how will the hedge fund manager save himself? Means he has a portfolio of 1,000 crores, and he knows that Modi ji is there. He will do some stupidity. So how will he save himself?
So invest in foreign currency reserves or something like that.
Okay, then Indian. Okay, then that is another thing. But if he is within India, means he cannot do. Yeah, if he invest in foreign currency, that's fine. Then then rupee will become weaker, so he will make money by conversion also. Yeah, that's very good. One example. But what if he is not authorized to invest outside? He is a small hedge fund, only a fund of 100 crores. Then how will he save?
So then invest equally in all the index shares.
And then the non-indexes are falling because of demonetization. Then he is like ETF or he is like S&P 500 investing. So beta is still there. Beta is 1.
Okay, then not invest.
Not invest, okay. If he doesn't invest, then he doesn't get any return also. But yeah, so he has only cash. So in that case, what will happen? That Modi ji doesn't do anything. Then his cash is earning zero. Because if he keeps cash, he doesn't invest in bond, then he will earn zero. And that will outperform. But the better answer is that he will. So if Modi ji doesn't invest, doesn't do any such drastic negative economic measures, then he is still losing because even the bonds earn some money. Bonds earn 4 or 5% or 6%, and equities earn a 9-10%. So then how will he save himself that? Because he doesn't know when Modi ji will do demonetization. or he will do some GST impose or some Corona lockdown. He doesn't know any of these. So how will he make money and save himself from market risk? Means his beta should be zero. If his beta is zero, then Modi ji cannot harm him. So how will he make beta when there is no uh, this acquisition and merger? He will simply invest 50 crore in long and 50 crore short.
Very short. Okay, sir. Okay.
Yeah, so that is in the equity hedge funds. That is known as equity hedge, long and short equity hedge funds. So let's go down and let us start. So do you feel we are becoming wiser?
Yes, sir. Definitely, sir.
Definitely we are becoming wiser. Okay. So we will study a lot of things. So now this one is first one is long short equity fund and event driven is so equity fund. What kind of hedge funds are in equity field who are dealing only in equity? So they will do long and short. In that case, if it is equal amount, then beta is zero and alpha is double. So in the long short, there are double alpha and zero beta. Okay, long short is then short biased. Short biased means he has some information that Adani is doing some illegal work or he is doing accounting fraud. So that way he will do forensic analysis and figure out that, okay, this guy has done some accounting fraud or something illegal. Then he will sort it because it is sort biased. He will sort it and then spread the news that, yeah, this Adani has done this kind of.
Oh, sir. Then that's why Hindenburg is known as a short selling firm.
Yes, they are
Okay.
sort biased hedge funds, yes.
Okay.
They are sort biased hedge fund in working sort. So they do forensic analysis. They do equity analysis, but then in equity analysis, they will do the forensic one. That which company has done this, and and the public has not known this. So like Vaxart
Okay.
had done, I had known, but the public had not known.
Yes.
So if I had the freedom, I would have made very good money at that time by short selling. Though I am an individual, so I wouldn't have got the
Capital business.
yeah the equities on loan to short, but still I could have done that. Means if I had been a hedge fund manager, I could have sorted that because I knew that the guy has not received money, but he spread the news that he has received money, and so people came to know after 3 weeks. So in 3 weeks, I could have made a lot more money.
So they would be focusing with their objective to short the company only. Like their bias would be to
Yes,
find negative things only.
yes. So they are having only one alpha, and this one will give negative return because the company looks healthy. Adani was looking very healthy company. It was prospering very rapidly. He had beaten even Mukesh Ambani. But then Hindenburg came and he spread the news. So he had already sorted Adani, and then he spread the news that, okay, Adani, here are the fraud that Adani has done, and now Adani, he has proved in court also. So now Adani is facing arrest warrant. So that way he made on. So these short biased hedge fund managers, they do forensic kind of analysis and try to figure out the frauds which the company has done and market has not known so far. If market has known, then the price would have fallen already. So they will not sort it. They will sort before the market knows.
Sir, then their beta would be what one, sir?
What? Their beta would
The
be, okay, yeah, their beta would be, since they have shorted one, they have not invested in the entire market. So beta shouldn't be one. Beta is one only when they invest, make a highly diversified portfolio. So their beta and alpha. So means they are still taking bigger alpha. Beta would be close to zero. If not zero, but it will be close to because they have sorted. So they are having that part of company's beta that they will have. So their beta can be even more than one. If this company is more volatile than entire market, then beta will be more than 1.
Oh, okay, sir. So like
Yeah,
we can't specifically comment on the beta.
yeah, we cannot explicitly comment on beta, but they are doing definitely taking alpha,
Okay.
and that alpha for short selling, so it will have negative correlation, so it will give diversification benefit. The alpha
Okay.
is positive because but since they have shorted it, so it will do differently than what others are doing, and so it will give good diversification benefit. So in equity, this one is a second strategy is short buy. One is long short equity, means they will long, they will short, and they don't know. Sometimes they will long more, and sometimes they will short more depending upon the opportunity they got. So that is long short equity. In this case, beta may not be 0. It is market neutral. Here, beta is equal to 0. So in this case, beta is equal to 0. Market neutral, that has beta equal to 0. Here beta, okay, here beta can be more than 1. So in short bias, beta can be more than 1 also. Beta undecided or less than, greater than, both can happen 1 or equal to, yeah. It can happen both. Greater than, less than, so where should I put equal to? In between. Okay, so beta can be either less than, equal to, or greater than 1, depending upon the company beta. So company beta will be there.
Sir, but on
Long, short,
long or short, beta will be 0 now.
long and
If it's
short beta, no, no,
if
no. Here
the
it will be 0 only when there is equal amount.
equal amount. Ah, yes, sir.
Yeah, so but here it is not. Here market neutral. Once market neutral means long and short are of equal value.
Oh, sir. Then market neutral is a type of long or short.
Long and short, yes. In
Okay.
which long value is equal to short value. So here beta will be less than 1 for sure. Beta is close to 0. Beta is close to 0. So in long and short equity, beta is close to 0. And here beta is equal to 0. So these are the 3 strategies of in equity field. Those who are doing only in equity. Now event driven, merger arbitrage. You already said that buy the stock of company B and short the stock of company A and earn double alpha. So the beta will be 0. Okay. Distressed securities. In distressed securities, what we had studied earlier also, what do they do? Okay, we will study again in detail when we go down. And then special situations and activists. So, as the name suggests, activists, we will discuss these there when we go down. Convertible, okay, then, so this one was event driven. Third strategy is relative value. Relative value means convertible bond arbitrage means what happens that the value of some assets is less relatively. It is not that it is 0, it is relatively less, and that happens with convertible arbitrage. So it is arbitrage, means fixed incomes are going to be converted into equities. So they will buy when they, okay, we will discuss in detail when we go there. Fixed income arbitrage also, we saw that this happens either because of illiquidity premium or because of this credit rating. So we can have fixed income arbitrage also, and then multi strategy. So all these are relative value. Opportunistic. This is global macro and managed futures. So managed futures are CTAs. We had studied earlier that they have all the information.
Yes, sir.
Yeah, so CTAs are managed futures. Global macro means they look at the top-down approach. They are good economists and they will say, okay, how will which country's government is well, what will Modi ji do, what will Trump will do, and what will the Fed chairman do. That way they do this macro analysis of trends. And on that basis, they bet. Then multi-manager is fund of funds. So fund of funds is two stage. You had already studied that fund of funds manager invest in 10 or 20
Only
different
tax,
kinds
huh?
of
Okay. Yeah.
hedge fund, and then there is double level of fee. Means he will also charge fee, and those hedge fund managers will also charge fee. So they had 220, and this one has 1 and 10. So this one is more liquid, quite liquid. Fund of funds is quite liquid, means you can take your money back. Yeah, hedge funds are not very liquid. So let's go down and study
So, sir,
some.
compared to private equity and the real estate and hedge fund, the initial capital required for hedge fund would be the highest, not?
No, not necessarily.
Oh.
But yeah, it requires a high amount of, but which will be highest. It can be for private equity also, but you and me cannot invest in hedge fund. Middle class people cannot invest
Ah,
in
yes,
hedge.
sir. Like in alternative investment itself, it's a very high barrier.
Yes, in alternative, it is for the rich people.
Ah,
We can go at most through fund of funds, but even these guys will ask for $100,000. Even the fund of funds will ask for $100,000 to invest. So, so it is not alternative investments are not within the reach of the people unless they do direct investment like buying a house or buying a farmland. You can buy farmland, but still you have to borrow for that.
yes.
So alternative investments are for rich people, institutional investors, mostly for them. We can be satisfied only by buying bonds and equities, and to some extent options. That's it.
Then, sir,
So,
if we complete CFA, then we will be managers of those funds.
huh?
If we complete CFA, then we can be manager of those funds.
Yeah, we can be manager of those funds. Yeah, that advantage is there.
Yeah.
And if you become manager of those funds, means you have really been a very successful CFA. And about 40% of the managers in United States, I don't know in India, Indian market is not developed. In United States, about 40% of the CFAs are either portfolio managers or hedge fund managers and alternative private equity managers. So there is a big demand of CFA in developed countries by these funds. So fundamental long short we have already studied. So I will move to obtain alpha. Okay. The manager typically maintains a net long exposure. So in fundamental long short, beta is not zero because the manager typically maintains a net long exposure, but may adjust the amount of net market risk depending on his or her market forecast. So if he expects that market is going to rise, then he will have beta more than one. And if you expect that market is going to fall, he will have beta even negative. So he can make that way. So it is fundamental long short. Long amount can be more than short, or short amount can be more than long depending upon his market forecast. So they have a long bias. So most of these fundamental long short hedge funds have a long bias, which differentiate this strategy from short bias strategy. So fundamental long short have long bias and it differentiates them from short bias strategy. Now, in equities also we have value equities and growth equities. So another hedge fund is fundamental growth equity. So where will they invest? Okay, now they will invest in high growth companies and then they will benefit by capital appreciation. What about these guys? They can get some dividend also, but since they short as well and long as well, so dividend is not the main idea for them. Means it is more for double alpha, earning the double alpha. Fundamental growth, they will invest in growth capital. So what will they do? They will short those companies which are not growing fast, and they will long those companies which are at initial stages and they have a good future of growth. So that is what they will invest.
Sir, I was having a doubt with the merger and acquisition. Like, if let's say that Z and Sony merger acquisition was supposed to happen,
Yes.
but it did not happen. So in
Then
that
he, then
case,
the hedge fund manager will lose.
he
If
will
it
lose
doesn't
two
happen,
alpha.
then he will lose.
He will have -2 alpha over.
He will have -2 alpha, yes, definitely, or it will be the same, yes. Means since he bought, then he will not get any alpha on that, and on short he had done, so he will not get any. Price didn't fall, price came back, so he will lose on the short position definitely. On long position means at what price he bought. Did he buy? Did the when the this cancelled when the merger or acquisition is cancelled, in that case, the price will return back to the stage where it had started. So, if he purchased at that time, then he will get what others are getting. And
Okay,
in
okay.
short, he will, since he had borrowed, so he has to pay some fee to the lender and some interest as well. So he may lose there. But there won't be much loss, but yes, he will not make money. He will lose in that case. If the merger doesn't happen, then since he has shorted, he will definitely lose on that. Okay, so growth and value, they invest only in growth and they do okay. So effectively, the spread between growth and value expectation drives. Means those companies which are growing fast, their price appreciates faster, their stock market appreciates faster, and those companies which are value, they pay dividends, their stock price doesn't rise very fast. And since it is shorting the value company and buying the growth company, so there is a spread between growth and value expectation, and that is what he will earn. So what about this one? This one is also long biased. Most of these portfolios tend to end up long biased. Hence, they may not be market neutral and their return may exhibit a non-zero beta. So for fundamental growth, fundamental value, no, not fundamental, yes. What was this? This was fundamental long and short or value? Tha? This was fundamental long and short. And then fundamental growth. All these have non-zero beta, but yes, less than 1 beta. Fundamental value. So it is similar to the growth. Here, it is just opposite of growth means they will, let's see.
They will invest in undervalued companies.
Yes. So fundamental have to identify undervalued and unloved companies for which there is possibility that a corporate turnaround will happen. With future revenue and cash flow growth will result in higher valuations. So they will invest in undervalued and unloved companies. So effectively, it is the spread between value and growth expectation that drives portfolio performance. So it is just the opposite. Here, it was growth and value expectation. You see here. Here, the spread between growth and value expectation for fundamental growth company. For fundamental value company, the spread between value and growth expectation means they have preference for expecting in investing in value companies, and
It's the same now, sir.
it is same. Only thing strategy is different means they will just do the opposite. What this guy will do, this guy will do opposite of that. Means he
Ah,
will sell value company and he will buy value companies.
okay, okay, okay.
Yeah. Short biased we already discussed a lot, and they do this often. Forensic in their fundamental analysis. So we have already discussed in detail. So let's see if there is something more. These funds can be addition to, okay. I mean, since they have this negative uh, correlation because others are buying and these guys are shorting, so obviously they have negative correlation with the market. So they can add diversification benefit. And when do they have difficult time? Short biased managers, however, have had a difficult time overall during the past 30 years of generally positive market conditions. So in the last 30 years, they haven't earned much. The short seller, most of the short sellers were wrong because they have to cover the short. So there is some cost in sorting. Means you have to pay the fees for sorting, for borrowing, and then what happened? You didn't earn the dividend on the sorted stock, and you paid the fees also. So that way, the guy who is owning that or from whom you borrowed, he is earning double income, dividend as well as the interest that he is taking from you for lending the stock.
So essentially, because they also manage high money, can we say the short biased hedge funds try to increase the inefficiencies in the market, because that is how they can survive?
There other they increase the efficiency. They don't increase inefficiency. They are exploiting inefficiencies. So they are basically reducing inefficiencies.
Like they have a very good incentive to say lies about the company and then earn money, no sir.
Yeah, but if they lie, then they will be jailed also.
Ah,
Yeah,
sir,
so that we have to
but the
put
regulation is
information.
not there, no sir.
Huh?
Like they are not as regulated, right? So they can say,
No, if they're
but
lied, but then the company will complain. No, like Adani. Why did
uh,
Adani didn't file a lawsuit against Hindenburg, neither in India nor in the USA? Because he had done those things. Means accounting fraud as well as manipulation from SEBI, all those things, whatever Hindenburg gave the charges. And Hindenburg said that, okay, come here, we will meet in the US court if you have the courage. Adani didn't do anything, neither in Indian court nor in US court. So that way, but had they lied, then Adani would have sued them and have asked for billions of dollars in compensation.
so I mean, they could simply say that it's based on their research, sir. No, sir. Like the
Yeah, it
researches
is based
can
on
be.
their research, but
Uh,
then if your research is faulty, how can you say this is forensic? Your research is based on, okay, where is the evidence of your research? You researched. How did you reach that conclusion? Means you will have to give those
sir, like
evidences.
we said, like the hedge funds can have selection bias, right? So like they could have had the selection bias or survivorship bias, and then fill their data, and according to their intent to spread negative things about the company, they could have done that.
No, if they spread negative thing, then it is illegal. So they will have to prove that this negative thing is correct. Means you can say, because you have to give the reason why are you saying so. In the equity report, when I wrote that this Vaxart has not received the money, I gave the reason. And I gave the sell recommendation and gave the reason that, well, this has not received the money. And the other reports are saying that it has received the money. So that way, then I had to show that I didn't find any evidence of money received. No check has been received. No cash flow statement is showing it has received money. So you have to show as an equity researcher. You cannot write lie. Otherwise, you will be jailed and you will have to pay the compensation also. Not only jailed, but you will have to pay the monetary compensation also if they sue.
Okay, sir.
Yeah. So that's how it is hard. Market neutral, we have already discussed that beta is zero and alpha is double. Okay, so here is the
Sir, so like so you can say these short biased are a necessary counterbalance for a
for fraud.
weakly efficient market.
Yeah, they are basically increasing efficiency of the market.
Oh,
Otherwise, who would have caught Adani? Adani would have been doing these frauds and nobody would have told anything because in Modi ji punishes whoever says anything against Adani. So
yes,
that
sir.
way it is the Hindenburg, a US company. That's why they could dare to say. Otherwise, nobody in India can dare to say anything against Adani.
Sir, but we just saw that over the past 30 years, they have not earned any good returns. So could that mean the
Yeah,
markets are performing
here it
better?
is. No, let me see. Here is the return sort bias. This is the period from 10-year period. Okay, by monthly a fund of fund hedge fund is benchmarking the performance of various equity strategy and over a 10-year period. So what did they earn in 10 period average? They earn only minus 0.5%. So most of them were wrong. They thought that they would catch someone. Many of them don't do forensic like Hindenburg. Most
Oh,
of
okay,
them
so so
expect that yeah, the price will fall, and then they become wrong.
okay,
So
okay, sir.
short bias people have earned only negative half percent, and the monthly return as measured by monthly hedge fund return. So this one is monthly return, half percent. How much did growth companies earn? They earned 0.3% per month. Market neutral also earned less because they had shorted half. And what about fundamental value? They made positive return. And market index means ETF. They earn 0.3% per month. So they earned a lot. But then index had lower standard deviation, means 2% monthly. But these guys had a smaller standard deviation. This one is zero point 0.5 is much less than 2. 1.5 is also less than 2. And this short bias guy had a higher risk than this. So this one is actually not giving increase in return or risk adjusted return. With others, you can say that yeah, risk is lower if return is lower, but it is only for 10 years. Let's go down the correlation, diversification benefit. So, which one is giving fundamental value is not giving diversification benefit because it has zero point 0.8. With equity market index is 1, means beta is 1. So here correlation is, oh, you know that the relationship between correlation and beta, do you remember or you forgot? The relationship between R and beta. Do you know the relationship or you forgot? If you forgot, I am writing again. R is equal to uh, covariance
Covariance of
XY
XY
means
divided
equity, this equity
and market.
and divided by variance market.
Yeah,
Okay.
yeah.
So covariance, this equity means what I would say E1, equity of the company EI, yeah, and covariance of EI, comma market, EI, and then market M. There is no MI because it is entire market divided by variance M. Hmm. So this is our correlation R. So this one, beta in this one is R is equal to, so I should write it, R is equal to this. And what is beta? So beta is equal to, uh, sorry, this one is actually beta. This one is beta. Actually, this one is beta. So this one is beta. Yeah. Okay, R and beta. I will put it here. So what is R? R is by variance X. So beta is covariance XY, EI by M divided by variance. So that is beta. Okay, correlation will be, yes, correlation R. Okay, so this one is beta. And then what am I doing? Sorry, beta.
Sir, beta into standard deviation of x by standard deviation of y is equal to
Yeah,
r.
that is there, but let me write the R also so
Okay.
that it is very clear. R is equal to covariance EI and M. Covariance of R is equal to covariance EI and M. EI and M divided by sigma SD EI
Square.
times no times SD M. That is what it is. Correlation is that SD M
Oh,
is
yes, sir. Correlation.
that
Okay,
is
okay.
correlation.
Okay.
Now, since this one is variance means this is SDM square.
Mm.
So if you multiply SDM divided by SDEI, you get this E. Let me make it bigger. SDEI, then you get correlation. Yeah.
Yes, sir. Yes, sir.
So here correlation is zero point 0.8 means
There is
times
no
this. Yeah. There is
diversification.
no diversification. Market neutral is providing diversification, it is 0.22. What about fundamental growth? Little diversification,
Okay.
not much. And what about this short bias? This is providing a lot of
Highest
diversification.
diversification.
the highest diversification. So short bias fund can still be added because it is providing highest diversification. So risk adjusted return will go up, even though total return will go down, but risk adjusted return will go up. So that way, it still has merit to be included in the portfolio. Now, event-driven strategies, merger arbitrage, we already discussed and you know it very well. So I go for the distress and restructuring. This I had said we will discuss. So in distress and restructuring, first company is on the verge of bankruptcy or already in bankruptcy. So what will the hedge fund do? In one approach, hedge funds simply purchase fixed income securities trading at a significant discount to par. Means par is the value of the security is 100 on face value, but it is trading for maybe 20, 30 or 40. So this hedge fund will purchase that. He purchased in the hope, but there are still senior debt to be backed by sufficient corporate assets. So his, okay, let me read this. In one approach, hedge fund simply purchase fixed income securities trading at a significant discount to par, but that are still senior enough to be backed by the sufficient corporate assets. Now, how will this opportunity come? It says that corporate assets are still there, yeah, but then it is being sold at a very high discount. Is it not market inefficient? And the answer is yes, because if it is backed by the asset, if the debt is backed by some asset, means there is loan to value ratio. And that loan to value is the ratio, and if the price is lower than the value of the company, of course, value went down, but it is not that from 100 it went down to 80. But the bond is selling for 40. So that is a clear sign of indication of inefficiency. Now, why does that happen? Why will that happen? And you had studied while studying fixed income that many pension funds, banks, they cannot keep equities below triple B minus.
Yes,
So
sir.
they will be forced to sell. So the event happened that the company defaulted. And when it's defaulted means it is no longer triple B minus. And when means all the banks and pension funds or insurance companies, they will be forced to sell. So there is suddenly excess supply of bonds. And so there will be deep discount. So that one is another legal, well, I won't say legal loophole. I would say, uh, okay, legal loophole contract means the existence of contract is making the market inefficient. Legal loophole means it is violation of law, but I won't say that. I won't say that the contract that banks cannot keep any the banks must invest in investment grade bonds at least. So whenever there is an event that making the current investment grade company to a junk company, these distressed hedge fund managers will get the opportunity. They will go and they will say the bank has to sell anyway because it cannot keep it. The pension fund may keep it, but the bank has to definitely sell it. Then many bond managers are also required to invest only in investment grade bonds, so they will also have to sell it. All institutional investors who are bound by this clause, they will have to sell it. So there will be sudden increase in the supply of distressed bonds. And these hedge fund managers will buy very cheaply because they know that, yeah, the company still has enough assets. So if it goes liquidated, then also I will make money. I will
Sir,
recover.
sir, for that, like the assets must be of like proper seniority now, sir.
Yeah, so this one is seniority. No, he said no, that that are still senior enough to be backed
Okay,
by
okay.
sufficient corporate. They are not buying equity. They are buying these debts. So that's why this is distressed debt hedge fund. So what is the expectation is that these securities would be valued at par or at least at a significant premium to the current bond purchase price in a bankruptcy, reorganization, or liquidation. So even if there is liquidation, these assets will be sold to someone, and that will value more than at what price he is buying. Then what is the another strategy? That a fund may purchase a debt instrument that is expected to convert it into new equity upon restructuring or bankruptcy. Means he will also buy the debt, means it will be convertible debt. And convertible debt in the means there are, when the company is going to be reorganized, restructured, so he has bought the convertible debt before reorganization. So after reorganization, the equity of the company will go up, and he will convert this debt into equity and make money. So these are called fulcrum security. Means these convertible debts are called fulcrum security, and they either hold on to the equity or exit. So the fulcrum means the one which supports, means where you put the weight of the something to be weighing. So fulcrum is like
Counterbalance.
yeah, counterbalance, or the one which supports, yes, supports weight. So fulcrum means they are supporting the company for reorganization. That's why they are called fulcrum security. So distressed restructuring gives a lot of opportunity to hedge funds to make money. So they want, actually, these hedge funds. They are also called vulture investors.
Okay.
Yeah. What is the another special situation? These strategies focus on opportunity to buy equity of companies engaged in security issuance or repurchase. A special capital distribution means buying of equities by the management. Rescue finance or asset sale spin-off means they are closing a division spin-off, or they are selling the assets, or other catalyst oriented situations. So in these special situations also, the hedge fund manager will come and they will buy. Why the company is doing, uh, that depend upon the special situation of the company. So they are doing research for that, and they will come. Activist, this one is interesting. So activist means the hedge fund investor is actively going to manage the company. So what will he do? He will buy some stocks. Initially, he has only 5%. He cannot do anything. Minority interest. Then he will buy some more. He will reach 20%. Then he becomes no longer minority if he has 20% of the ownership of the stock, but he will get a seat in the board of directors. He will buy some more, thinking that the company is really inefficient. So if I manage this company, I will make more, because the company is doing bad now. So when the company is doing bad, this activist investor or hedge fund manager thinks that he has the skill to remove the efficiencies of the company by changing the management, means by himself participating as the manager, means CEO. So what he will do, he will get a board of director seat, then he may get one and he buys some more and he may get two. And when he has got two board of directors, means he has enough. So if he has purchased 30 or 40% of the stocks, he may get some support of other independent directors, and they may fire the CEO. So that way, and when the CEO is fired, he will become the head of the company. He will himself become the CEO, or he may appoint someone uh, in
So,
whom he
this is like if Elon Musk had a hedge fund and if he had invested in Twitter, then it would have been the
Yes,
case. Yeah.
Elon Musk did that. Elon
Sir,
Musk was the
but he
activist
did it
investor.
with his own money, not sir.
Yeah, he used his own money,
Own
yes.
money. Had he done
But
it with a hedge fund, then it's activist hedge fund.
then he would have been activist hedge
Yeah.
fund, yes. So Elon Musk used his own money. Okay. So activism of Carl Icahn. Carl Icahn is a hedge fund manager. Do you know what is the salary of a hedge fund manager? How much the best hedge fund manager paid? Let's see. And you will be shocked. Highest
Around 30 40 million
30, 40
million
billion. Million or billion?
million.
Oh, no, 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 no. Highest paid hedge fund
Sir, I'm
manager.
not able to see that, sir. I'm only able to see
Oh,
the billion.
okay, 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 okay. Yeah, yeah. You can see here. Here you can see, no? Can you see if I press
Yes,
here?
yes,
Here you
yes.
can see. Acha, highest paid hedge fund manager. Okay. Kenneth C. Griffin, Paul Singer, top five highest paid hedge fund managers. And can you see this? And how much did they get the salary? A hedge fund manager, what is this hedge fund? Ken Griffin. In 2022, 4.1 billion. Griffin's personal earnings were around 4.1 billion. That is what he earned in 2022. Then what did the second guy earn? Israeli Englander Stephen Cohen. He earned, okay, and earned its investors profit of 2.4. Kevin earning were 1.9 billion. So that's the kind of money the hedge fund managers get, having this 20% bonus, performance bonus, and 1% AUM. So he got 1.9 billion, and this guy got 1.2 billion, David Tepper. So highest was 4.1 billion in 2022, received by Ken Griffith this year, 4.1 billion. Ken Griffith. Ken Griffin, he was the highest paid. So you can become billionaire within 1 year if you are a good hedge fund manager, a star hedge fund manager. So that's why hedge fund managers, everybody wants to be a hedge fund manager. All those who are smart and enthusiastic, that they want to be hedge fund manager. So we studied so far those strategies. So now we have relative value strategy. So what was these strategies? These strategies were which ones? Event driven, no? Market. These were These strategies were here event driven. So merger acquisition, distressed, special solution, and activist. All these are event driven hedge funds. And equity we already saw. Now relative value, opportunistic, and then multi-manager. Multi-manager is the simple. Means he will, this fund manager will invest from these. He will choose hedge funds from these because he has the history that which hedge fund manager did what in the past, and that way he maintains the history, and he supports the index of hedge fund performance. So he is paid for that. So most of the investors who are high net worth but don't know anything about hedge fund, then they are willing to pay double fee and to pay to the fund of fund manager, and in return they get liquidity also. Means you can withdraw your money quickly on short notice. But if you are investing in these hedge funds, then you may not be able to buy, because the guy who bought distressed security, now the reorganization of the company may take 2 years till it is either liquidated or again reorganized. Then for 2 years you cannot withdraw your money. So that way hedge funds are illiquid also. Only the fund of funds hedge fund is liquid because many investors are continuously pouring money in it, and some are coming out also because he has invested in different maturities of hedge funds. So that way he has some very good amount of liquidity. So we are now studying relative value and then opportunistic. So opportunistic we will study in detail. Yesterday we had studied CTA and we will study global macro. Now, relative value strategies are convertible bond arbitrage. We had already discussed that this cons this conceptually market neutral investment strategy seeks to exploit.
Sir, can we take a 2 minute break, sir? I just want to go
Okay,
to watch.
yes. Oh, sure, sure, sure. We will come back. Okay. 2 minutes break. No, yes. Go. You can call me.
Yes, sir. Yes, sir.
Yeah, you call me. Okay.
Sir, hello, sir.
Okay. I am here only. Let's study. So we are going to study relative value strategies and convertible bond arbitrage. So the hedge fund manager looks at, he wants to exploit perceived mispricing between a convertible bond and its component parts. So convertible bond has two parts. One is the bond and the other is embedded call option. So there will be mispricing of call option because bond mispricing is often well calculated, well researched. There are fixed income analysts who will correctly price the price of the bond, this discounted cash flow of coupons and principal. But this there is a high possibility that the call option is mispriced. So this hedge fund manager will typically buy convertible debt securities because the call is cheaper, and then he will convert it, and simultaneously selling a certain amount of same issuer's common stock. So here he is buying the convertible bond and selling the common stock based on delta of the embedded call option. So this strategy we know from before. So
So,
this strategy, yeah.
can you explain it with an example, sir? I'm not able to understand this.
Okay. So the delta of the call option means, though the book has not given the example, but I can explain it. So convertible bond and delta of the call. So delta of the call is that
Change in
if the
price of
change
the
in price, yeah, from the
stocks
change in
by
price of
changes
the,
in future.
yes, so from the price of divided by the change in the price of the equity. Yeah, change in price of the call
Uh,
divided by change in the price of the
Price of the
equity.
equity as well.
Yes, so that is the delta. Now, if the call price changes at 25%, when equity changes by $1, so delta is 0.25. So what he will do that he will buy, he will short one equity, then he will buy four calls
Oh, okay. So to make it delta neutral.
to make it delta
Okay,
neutral. Yes.
okay.
So he will buy four convertible bonds and sell one call. So that is what he will
Okay.
do.
Yes, sir.
So this, uh,
So in this case, how much alpha and beta will he earn, sir?
beta will be zero in
Oh,
this case because he is using it is risk neutral. No,
yeah. Okay. He's negating
yeah,
the market risk.
yeah.
Okay.
So there is no risk at all. Market beta will be zero in this case.
Alpha, sir.
Alpha. Alpha will be it will be delta based. So so it is the spread delta means because here what he is doing that he will convert. So one is 4 alpha on bond, but bond alpha is not equal to the equity alpha, no, because he is selling one equity, so that is minus 1 alpha. But then he is buying four bonds. So what would be the ratio of bond alpha to equity ratio? Means it says that it is mispricing. So whenever there is mispricing means he will not lose. So if there is no bankruptcy, the company survives, then he will make money. But if there is bankruptcy, then he will not make money. He will lose money because his call will expire zero. So whatever sorted he equity, that will be the loss because uh, he will have to. If he's sorting the equity, then equity becomes zero. So actually, he will be benefiting. But then the bonds will become zero. Well, I don't know how much bonds will become. The price of bonds will fall. The price of equity will also fall. So if it is not delta neutral, then fall in the price of equity will be more than the fall in the price of the bond. So that way, he will make money because he has shorted equity. So alpha shouldn't be double in this case uh, because he's going to lose money on bond.
Sir, so alpha will definitely be positive.
I will definitely positive, yes. So, but what happens when bankruptcy happens? Then in that case, the company is closed, and so he loses the opportunity to convert his bond into equity. So in that case, he will lose.
Okay, sir.
So yeah, so the loss of bonds would be more than that on the loss of equity. It means what if the bond also becomes zero? So if bond also becomes zero and equity also becomes zero, then he lost three bonds and he lost three extra bonds, no, because he had purchased and he gained on only one equity. Now, what was the price of the equity? What was the means? It is a complicated situation. Means we cannot do it unless we have this exact prices. But alpha is definitely positive
Yes,
if
sir.
the company is surviving. Yeah. Then fixed income general. So we saw convertible bond arbitrage and fixed income general. So these strategies focus on relative value within the fixed income market, such as emphasis on sovereign debt and sometimes the relative pricing of investment grade bonds. So we had seen that as the credit quality of the bond improves, its price goes up. So there is very high chance that there is mispricing of bonds. Uh, and how do we know it is high chance? Means if the company is now triple B minus rated, it does better next year. And its EBITDA, this interest burden ratio decreases, EBITDA improved, EBITDA by sales that improved, then its credit rating can go up. So after analyzing the cash flow statements and making predictions, the hedge fund manager can figure out that yeah, this company is going to have an upside potential. So right now its bonds are cheaper, and if its credit rating improves, then they will become higher, and he will make money. Or the other way around also. If he expects that the company is doing bad, means its credit rating would be downgraded, then in that case he will sell the bonds and then make money once the credit rate downgrade has happened. So he will short the bond, not sell means he will short the bond, so borrow and short it, and then he can make money. So that is like uh, it is not it is more it is not like equity neutral, because here the credit rating is impacting the market and also impacting the profits of the hedge fund manager. So
Sir,
he will,
fixed income analyst will also do these things only, no, sir. But
yeah, but the hedge fund manager has, of course, employed fixed income analyst.
okay, okay, okay. Oh,
He also has employed fixed income analyst. It is
okay.
not that he has not employed. Now, the fixed income analyst is, if he's on the long side only, means he cannot short. Then even though he says that yeah, the price will go down, but at most what he will do, he will simply sell what he has.
Okay.
He cannot sell, he cannot short it. So if he cannot short it, then he can earn only one alpha.
Okay. Okay.
Yeah, but this hedge fund manager will earn double alpha.
Okay. Okay.
Yeah. Then fixed income, asset back, mortgage back, and high yield securities, high yield or junk bonds. So these strategies focus on again same relative value of various higher yielding securities. Means they can be junk bonds also, and they can be, well, higher yielding means all are junk bonds, such as, oh, higher yielding securities asset back also. So asset backs, mortgage backed securities, and high yield loans and bonds. So high yield loans and bonds are junk bonds. Asset-backed securities and mortgage-backed securities, we have studied that they are secured loans and they have tranches, different tranches also in
Yes,
the
sir.
mortgage. Yeah, so there also there is a chance of making money, and their derivatives. Yeah, so derivatives are the tranches. So hedge funds, it is not that only call, puts, forward, futures are derivatives. These tranches are also derivatives. Then
Sir,
hedge
how
funds,
are they derivatives, sir?
because they have been derived from this underlying mortgage-backed security. No, they are not those bonds.
Oh, okay, okay. In
Yeah,
that definition,
I mean
okay.
they have been classified into
Class.
no most
Oh, okay.
liquid, senior,
Ah,
less senior,
okay.
junior.
Okay.
So they are derivatives. They are derived. Okay. So, okay, so they seek to attract revenue from highly secured coupon returns and exploit relative security and quality mispricing. Again, quality mispricing is there, means credit upgrade and downgrade they will see. Multi strategy, they will invest not only in fixed income, but in equities and funds and real estate, although they will invest. So they will invest in across asset classes or instruments. Mm. The goal of multi-strategy manager is to initially deploy capital efficiently and quickly across various strategy areas as conditions change. So he will initially build a very diversified portfolio, and if the situation changes, means one sector grows faster than the other, what he will do? He will simply sell the one which is growing slower and buy the one which is growing faster. So he has the freedom to change quickly because he has already invested. So that is multi strategy. So these were relative valuation hedge funds. Then opportunistic strategies. These are also macro strategies hedge funds, and they emphasize a top-down because it is macro strategy approach to identify economic trends. So trades are made on the basis of expected movements in economic variables like GDP movement, industry movement, and they invest in all fixed income, equity, currency, commodity markets. All they need to do is to find out the trend, that how the trend is going to be. Like rupee trend is negative, means rupee is depreciating. So what will they do? They will sell rupee today and buy dollars so that they can get more rupee later on. So because these funds generally benefit most from periods of higher volatility. Okay, so higher volatility when happens whenever there are business cycles, means either at the peak or at the trough, there is higher volatility. Means first is going down, then coming up, or first it is going up and then coming down. So that way there is higher volatility. Uh, so these funds generally benefit most from periods of higher volatility. The active moves by national authorities like demonetization and raising of the active moves by national authorities, and then such as central banks, to smooth out economic shocks likely shrink their investment sphere. It is telling that if the central bank is doing counter cyclical to reduce volatility, then they will not benefit much. These macro strategies, they best they invest on the basis of expected movements in economic variables. So trades are made on the basis of like this John Paulson. He made 3.7 billion in 2008 mortgage crisis. Means he sorted all the mortgage-backed security and then bought them at very low prices after 6 months, or 1 year. And in 2009, he made $3.7 billion. John Paulson. I know him very well because I was studying about him. So John Paulson. So that was this. He was, I would say, macro strategy. John Paulson, you can see here.
Yes, sir. I think in the movie also he was discussed, sir.
Oh, you have seen this in the movie. Okay.
The Big
John
Short
Paulson.
movie, sir.
Okay, yeah, he's the John Paulson, yes. So he made that much money. He made a lot of money. And, American billionaire hedge fund manager. So, yes, okay. So if you've seen them, maybe let's move forward. And then manage features. Here it is the CTOs. So let's read them in detail because this paragraph is important in natural resource as well. So in the
Sir,
city,
for before that, like in the macro strategies, could VIX be a good indicator, sir? Like if VIX is lower, then these funds cannot earn much.
VIX, when VIX is lower than this, that is an indicator, yes. VIX is a good indicator of macro strategy because whenever this central bank tries to take some decision or the president or prime minister, then yeah, VIX increases. So yes, that can be an indirect indicator, but actually what these guys will do, that needs to be predicted. So how will they know that? They have these people, politicians as friends, and they will tell that after 1 week I am going to do this, and then these guys can make money. So macro trend people. But anyway, they have their own analyst also, economists as well, mostly, who are better in predicting macro trends. Managed future funds are actively managed funds. So this one is futures. So this one is very liquid because futures are very liquid. They can be sold very quickly within minutes. So managed future funds are actively managed funds making diversified directional investment primarily in the futures market on the basis of technical and fundamental strategies. So technical strategy and technical analysis and fundamental analysis, that is what it means. So They are also known as CTAs. Managed future funds are also known as CTAs, commodity trading advisor, because they historically focused on commodity futures. And that was their strategy was backwardation and contango. So they earned convenience yield. And that's why the managed futures, the CTAs became rich. So, however, CTAs may include investment in variety of futures, including commodities, equities, fixed income, and foreign exchange. So they can. It is not that they will invest only in commodities. Now they can invest in all asset classes. They generally use models that measure trends. Yeah, we saw that they earn convenience yield, and whether it is contango or backwardation. So if it is backwardation, then they will hold the commodity and not sell it. And on the expiry day of the future, they will make money because future price is lower than the spot price. So the difference goes into their pocket. So what do they do? They make predictions that where is shortage and where is surplus. So if it is surplus, then what will they do? Means the future price will go. Right now, current price is low, and future price will be up because the surplus is now. After some time, it is possible that the farmers didn't produce or miners didn't extract mines, and so after 1 year, there may be shortage. So in the shortage, again, the current price will be higher and this future price will be lower. So in that case, what will they do? They will buy lower, means they will long future. So when it is contango, they will long futures. And when it is backwardation, so they should short future, means they will sell. No, then also they should be long, they should long future, because in backwardation, the current price is higher and future price is lower. Oh yes, yes, they will long. They will long because they will sell it in the spot market and buy in the future market. So in backwardation, they will long futures, these CTOs, and in contango, they will short futures and make money. Since they have information about demand position, supply position, at least of commodities they had. What about equity, fixed income? Probably not so well, but about commodity, you know that how much is in the store. The physical commodity, they need a storage. And then who is the producer, which country has produced how much and how much is in the export or on the seat, that they will know. Because they will know that, okay, how much goods have been shipped. Someday it will reach market. And the transport, during transportation time, they will have the specialized information, because many people will not have this information, that how much was shipped from where and for which port it is going. That information they have, and that way they make money out of that. Means they earn convenience yield. So city investment can be useful for portfolio diversification, mm, particularly in times of a strong trending market condition. Yeah,
So,
whether it is,
just like we had seen yesterday, they would only deal with anything related to physical commodities.
now it is they are dealing with equities. Yes, this strategy is related to physical commodities,
Okay.
lending market. But now they've been allowed to in foreign exchange also. No, then fixed income, equities, and commodities. Yes, very much clear. That is very much clear. In fixed income, how will they know that? Foreign exchange, I can understand that they can predict foreign exchange depend looking at the balance of payments. Balance of payments account, they can predict foreign exchange. But how will they fix fixed income? That requires macroeconomic analysis, like those fixed income analysts also predict no that whether interest is going to be raised or decreased. Based on that basis, they can predict fixed income also, but it is quite difficult. But for commodities, they had the monopoly of information, and so they have historically made a lot of money. So whenever they, especially when do they make, especially during periods of extended market stress, when other fundamental strategies may be expected to perform poorly. Means during COVID-19, CTS made a lot of money, but the rest of the equities and bonds, they perform poorly. CTS can be relied on to profit from having purchased short positions in falling market. Yes, they purchased short position in falling market, and then moreover, mean reverting markets, which may cause false momentum breakout signals, can lead extended drawdown periods before a strong trend emerges. Okay, so markets mean reverse. So, to the extent that CTS have migrated to trade more and more financial products such as stock index and bond futures,
So,
the reliability of yes,
basically, in times of stability, CTS will not be useful.
no. In times of stability, there will be neither backwardation nor contango. So they will be making only normal money, not much. They will not be very useful. Yes. So what does this tell now? So commodity futures, managed future funds are unique. Means global macros because there is a constant price tension between supplier and consumer. Yeah, uh, the price tension is always, and that is what CTAs make money. Means there will be excess supply now, then producers will cut production. Then after 1 year, it will become a shortage, and so that way while demand will remain the same. So there is a price tension between suppliers and consumers. So high prices cripple demand. High prices now there is shortage, there will be demand shortage. Okay. So tending to lower prices and low prices shut in supply and thus raise prices. So there will always be a tension between demand and supply, that cobweb model. So this
Okay,
sequence creates a unique balance absent in traditional stock and bond market. So why will CTAs always make money? Means the supply and demand thing will always be there, which is not available to traditional stock and bond market. Hence, CTAs provide excellent diversification benefit.
okay.
Okay, so now you will know what is the distinct, why hedge funds are distinct from mutual funds and ETFs, because they have less legal and regulatory constraints than mutual funds and ETFs. Then flexible mandate permitting use of shorting and derivative, means they can short also and they can use derivatives also. So that way they are flexible, which is not available to mutual funds and ETFs. A larger investment universe on which to focus. So ETF and mutual funds have their own initial decision, but hedge funds have no such thing. They can focus on entire universe, larger investment universe. Then aggressive investment styles, yes, they have the full discretion. They can always go unbalanced. They can be illiquid. They can have this exposure to credit, volatility, liquidity risk premiums, and relatively liberal use of leverage. Means relatively liberal use of leverage. Means they borrow a lot. Then liquidity constants that include lockup and liquidity gates, means we had studied liquidity gates also yesterday. Lockup means you cannot withdraw your money for 2 years. It has been locked up. Liquidity gates, yeah, you can withdraw your money, but you have to give at least 90 days notice. And with the notice, you cannot withdraw more than 20% at a time. So then there will be 90 days times 5. So 20% means a gate is made. So all money cannot be withdrawn, but only the one which passes through the gate, that can be withdrawn. So that is those are liquidity gates and relatively high fee structure because they get management as well as incentive fees. So these 7 distinctions make hedge funds unique. The rest of the things we have studied. So
Sir,
let's
but the liquidity constraints will be there in hedge funds, but not in the traditional mutual funds, right?
No,
Okay,
not in ETF, nor in ETF are most liquid,
okay, okay,
even
okay.
more liquid than mutual funds, because
Hmm.
mutual funds have to convert cash. Means if you want to withdraw your money, then you will submit your share, mutual fund share, and then the mutual fund manager will next day sell your part, and then means he will sell all the equities or bonds wherever he has invested containing your part, and then give you the money. Hedge funds, the ETFs, and they don't even sell it. They simply give you those stocks and bonds in your name, and then you are free to sell it. So that way, ETFs are far more liquid than mutual funds. You
Sir,
will see that. Yeah.
can you explain the third point, sir?
The third point, okay, sure.
Uh,
The third point is a larger investment universe on which to focus. Larger investment universe means they can focus on all the asset classes, not only equities and bonds, but also on commodities, foreign exchange, other hedge funds.
Sir,
And
but that would be the case for the funds of funds only, no? Like, but if it's an
oh,
equity focused hedge
oh,
fund, it
okay.
will
Yeah, fund of funds will invest in different hedge funds.
different. Yes, sir. But
But
if it's
the same hedge fund can invest in many. It is not that it is only fund of funds invest in other hedge funds. But this hedge fund, who is only one, he can invest in all of these asset classes. There is no mandate, no means where he will invest, it is not defined.
oh, okay. So, sir, in case the let's say we have that fundamental growth
Hedge
hedge
fund.
fund,
Yeah. So they invest.
he goes wrong with this equity assessment.
Yeah.
Then could he have invested in other asset classes, sir, or he can only invest in
No,
equity?
no, he can invest in other assets as well if he
Okay.
goes wrong in this. But
Okay.
then he should show that, yeah, I know that part also.
Okay. Okay. Yes, sir. So,
If it,
in that case, there is no restriction.
there is
But
no
in the mutual
restriction.
funds, you have the restriction. Like they
You
can
have the
only.
restriction
Okay. Okay. Okay.
that you have to define. You have to invest only as per as
Okay.
per the defined objective of mutual fund or defined horizon of mutual fund. You can invest only in those equities or bonds. Okay. Lockup period we have already discussed. Gate also we have discussed. Now a redemption fee may be charged apart from lockup period and gate. This liquidity gate, they can charge redemption fee also to discourage withdrawal and less liquid and unnoticed. Okay. Redemption article link. Okay. Now transparency. There is also reduced transparency for more complex hedge fund investment because hedge fund manager will not tell his strategy to the investor. He will say, if I tell you my secret, business secret, you will also become a hedge fund manager. Why will you need my services? So that way, since they are complex hedge fund investments and there is asymmetric information between manager and investor, means the manager knows much more than the investors. So this leads to incentive based performance so that the interest of the hedge fund manager and the investor is aligned. Asymmetry.
Sir, but asymmetry will not be there because the moral hazard is eliminated now, sir.
No, no, asymmetry of knowledge will always be there.
Oh, okay, okay. Only
Because,
then they can exploit and make money. Okay.
yes. So the hedge fund manager will not share his knowledge to the investor.
Okay, okay. But
Ye-
he will make sure the fund gets the money. Uh,
Yes.
okay, okay. I'm not sure. Okay.
Yeah.
Sir,
Mm,
if a hedge fund uh, promises in a pitch meeting to big investors that they will get 15% return, but they're not able to get it ultimately at the end of the day, then can they be sued, sir?
no. Yeah, if they make promise, first of all, they cannot guarantee. because in finance world nobody can guarantee.
Yes, sir.
Yeah, so that way it is illegal in the sense because he cannot guarantee. So if he's doing that, then yes, he can be sued because he said that, oh, he cheated us. So first of all, the investors are not stupid who are going to invest with hedge fund. They are not that stupid that they will believe him. They will not invest with him at all. However, there is a risk of fraud risk for hedge funds, and there have been fraud risk. Who was the most famous person who did the most famous hedge fund manager who did the biggest fraud in the history? Do you know his name?
Biggest
Bernie
question.
Madoff.
Oh no, sir.
Oh, you don't know him, Bernie Madoff. He died in jail, and this Bernie Madoff, he was the biggest hedge fund manager. Let me see. If you can you see this or not? Let me
No, sir.
here. Yeah, you can see here only Bernie Madoff. So he made the Bernie, Bernie Madoff. He remained in news for Bernie Madoff Ponzi scheme. So let's see. Yes, he was the founder of Nasdaq. The Nasdaq equity in yeah, he was the founder of that. So Bernie Madoff was an American financial criminal and financier who was the admitted mastermind of the largest known Ponzi scheme in history. So largest known Ponzi scheme. He died in jail, and when did he die? Let's see. I think he died in jail at the age of April 14, 2021. He died recently, and he had made that Ponzi scheme in 2008-9. So he was caught in 2009, and after that he was sent in jail, and then he remained in jail for 12 years and died. So
Oh,
he was the largest Ponzi scheme. So hedge fund managers have committed frauds. It is not that they have not committed frauds. And do you know what some of them did? Some of the hedge fund managers they gathered $500 million and flew to African country like Burundi or somewhere where USA didn't have what is that returning repatriation treaty.
oh, okay, sir. Got
Yeah,
it.
and he settled there. So he became the friend of the president, got asylum, and had $500 million in 2010 or something like that. So, so there is the risk of fraud, and oversight is needed for that. Okay, we saw that they generate double alpha, and they also provide diversification benefit. Yeah, so investors should consider several issues when choosing a hedge fund, and they should review their limited partner capabilities, means how qualified those partners are, their operational framework, their risk management practices, and hands-on monitoring of portfolio. They should manage also. They should keep watch how the portfolio is being managed. So, as for the general partner performance, the investor should consider their fiduciary management guidelines. Means, is the manager really doing his fiduciary duty? Means fiduciary duty means trust. Fiduciary means you trust someone, and that guy cheated, then he is not doing his fiduciary duty. Okay, manager experience and alignment of interest towards the fund strategy. We saw already alignment, and manager experience is available in the history of the manager. And then there have been quite a few reported incidents of fraud. I already discussed that, and it was Bernie Madoff, this Ponzi scheme. As a Ponzi scheme, who was that? Is there, I think his name was there, Bernie Madoff, not here. Okay. This I knew this Ponzi scheme. That's why I recognize that guy. So what is the conclusion? The conclusion is that while evaluating the investment, the investor should take into account its strategy. Means what is the strategy of the hedge fund? We saw 5 categories of strategies, which has around 20 strategies we studied. transparency, liquidity, and reporting practices. So these four things means how they are reporting monthly, annually, quarterly. That one, then how liquid they are, and are they showing transparency means they are giving the current information. So, in addition, the investor should thoroughly evaluate the fund manager's past performance and be aware of how the fund compensates the fund managers, means performance bonus or only fees, or either or. Means you will take either performance bonus or fees. That one is the best way of aligning the interest of the hedge fund manager with the investors, and also it reduces fee and calculates the fee charges to you. Okay, so that is what the investor should look. Means the history of the manager, his reporting practices, the liquidity of the fund and study. Okay, so please read question number one. Hmm.
Both hedge funds and private equity invest in equity stock of public or private enterprises, and there are many commonalities between them. The following statements are some of the commonalities, and one of these statements is false. Choose the false statement.
Hmm.
Both are structured as partnerships of investors with private pooling of funds and are primarily intended for high net worth individuals. True.
Yes.
Both utilize leverage to invest in a variety of marketable securities. True.
Hmm.
Both are less liquid than mutual funds or ETFs. True. Both are less regulated and the transparency or reporting requirements are not strict. Answer A
Hmm.
is both are structured as partnerships of investors with private pooling of funds and are primarily intended for high net worth individuals. Both utilize leverage to invest in a variety of markets. Sir, B is not true, sir, because hedge funds invest in
Have
both public
variety
and
of
private,
market, very good.
variety, whereas
Yeah, and the private equity has
private
only
only
an
in private.
equity. Yes, very good. B is the correct answer. Hmm. Okay.
Both hedge funds and private equity invest in equity of shares of public or private enterprises. However, there are many differences between them. The following statement lists out the differences between them. Uh,
Hmm.
Private equity funds invest for the long term, while hedge funds invest in equities for the short term. No, sir. There is no
There is
specific
no such thing that they will invest only
uh,
for short term. They can also invest for long term.
long term. Typical hedge funds are transaction oriented. They make several offsetting trades. Private equity funds are make stable long term investments in few companies. Mm, an investor normally funds the hedge fund at the start of the investment, while private equity funds are committed at the start and funded over time upon demand.
This private equity part, yeah, this part is true, but at the start, even in hedge
Upon
fund,
demand is
yeah, even in hedge fund also, they can have demand at different times. Normally funds the hedge fund at the start of the investment. It is not necessary
yes,
because
sir.
hedge funds also can demand funds, because both we use IRR. Mutual funds you have to fund at the start.
Private equity is redeemable on a periodic basis, while hedge funds require long-term commitment. No, sir, no such rule.
Absolutely not. So D is wrong. It is not redeemable on a periodic basis.
So then A is wrong, D is wrong.
So it
Everything.
is the statement that is false. It is the difference between private equity. Yeah, so two can be answers.
Sir, then B, typical hedge funds are transaction oriented. They make several offering trades. Private equity funds make stable long-term investments in few companies.
Private equity, this part
Sorry,
is correct.
that
Private
part is
equity funds
yes.
make a stable private equity fund. Oh, it is funds. Private equity fund. It's not private equity. Private equity fund will invest in other private equities. So then
Sir,
this,
there is only one false because they are saying choose the statement that is false. So there should be
yeah,
only one
choose it
answer.
is okay. So let's see which one can be false. Private equity funds invest for long term. This one is correct. While hedge funds invest in equities for the shorter term.
False, sir.
This one is false. So
So
choose the
why
statement.
only equities, sir? It can invest in anything.
Yes. Yes. So they can invest in anything. Yeah. While hedge fund invest in, yeah, this one is false. Yeah, so A itself is false. Okay, let's see. Typical hedge funds are transaction oriented. Okay, means it should be investment oriented. They make several offsetting trades. That's also correct. Private equity funds make stable. So this difference is correct. So this one is not false. B is not false. An investor normally funds the hedge fund at the start of the investment. This is not necessarily true.
True.
Yeah, because he can fund later on also, on demand also, because it is committed capital.
Yes,
So
yes.
that is common to both hedge fund and private equity. So, so what about this? Is false or what? I'm getting okay. Now, private equity redeemable on a period? No, it is not redeemable. So D is not correct. While hedge
Sir,
funds,
can you scroll up, sir? Let's see the full question once again.
okay.
Both hedge funds and private equity investing in equities as a public or private enterprises. However, there are many differences between them. The following statements list some of their differences. Shows a statement that is false.
Hmm. So the difference, what is the difference between private equity and hedge fund?
Funds.
And which one is false? So if it is true, then that is not the answer. So invest for long term, this part is correct. But hedge funds invest equities for shorter term. Yeah, it is not. So this difference is actually correct because they don't have to invest for 10 years. They can invest for shorter term also. So this one can be language is quite confusing. Okay. Typical hedge funds are transaction oriented. This one is also correct. They make special offsetting trades. Several offsetting trades means long and short.
Yes, sir.
That one is also correct.
So between A and D only we have to say.
A and D. Okay. So let's look at D. Private equity is redeemable. No, it is not redeemable on a periodic basis. While hedge funds require a long term. This one is wrong. D is wrong. Because private equity is not, what is the answer? D is wrong. Yeah. Because they cannot withdraw for the first 5 years, so it is not redeemable on a periodic basis. They can withdraw only uh, after 10 years. Well, after 7 means once it has started giving positive cash flow, then only they can withdraw. So D is wrong. Okay, question number 3. Yeah.
Hedge funds versus mutual funds. Choose the false statement. Mutual
Hmm.
funds are open to any investor and are generally more liquid instruments with minimal constraints on redemptions.
Yeah,
False, false.
yeah,
Sir, false, sir.
it is false.
Minimal constraints on the
Mutual funds are open to any investor. This part
that
is
is
true.
liquid is
And
true.
are generally
Minimal
more liquid instruments. This is also true. With minimal constant on, yeah, on
on
redemption.
redemptions. Okay.
Yeah, you can withdraw anytime.
Okay.
Yeah, so that's correct.
Uh,
True.
Hedge fund fees are typically negotiable by an investor, while mutual funds operate with same fees for all investors.
Yeah, this one is also
That is
correct.
also true. Sir.
Yeah, because they have separately managed accounts. So
Yes.
in that case, they will negotiate.
Hedge funds are more restricted in what they can trade. False.
No, so C is definitely wrong. C is correct answer. Okay. How many of the following statements comparing hedge? Okay, yes. So how many? It can be more than one.
Multiple answers.
Yeah,
Sir, are there only 4 or 5?
I think there are only 4. Yeah, one of the statements here. Oh, okay. So the question is
Question itself
actually
is
here. Huh.
how many of the following statements comparing hedge funds and ETFs are true? ETFs are exchange traded public securities, while hedge funds are private partnership funds. True, no,
Mm,
sir.
hedge funds are private partnership. Yeah, this is true. Yes, private
True.
partnership. Yes, correct.
Any investor can invest in an ETF while specific restrictions apply to who can invest in hedge fund. True, sir.
Correct. Yes,
ETFs are very low fees and expense ratios compared to hedge funds.
correct.
True. ETFs are highly regulated with specific reporting requirements, while hedge funds are lightly regulated. True. All are true.
True. So
D.
D.
Yes. Select the statements that are true. Oh,
Oh, yes.
I see. The
Yeah,
primary drivers of returns from stocks are growth projections, dividends, and return earnings. Yes, sir, true.
yes,
Primary drivers of return from bonds or interest rates, credit risk, coupon payments. Yes, sir.
yes.
Primary drivers of return from hedge funds are volatility and inefficiency. True.
So all are this exploit market
Inefficiency.
inefficiency. So it is the book itself is telling that market is inefficient. Otherwise, there won't be hedge funds.
Yes, sir.
The book says that they are semi-efficient, and now it is saying that no, hedge funds are exploiting market inefficiency. Okay, so there is problem with the CFA. What I would say, those guys who are
Consistency.
huh?
They are inconsistent.
They are inconsistent. Yes, because if and the hedge funds are many, you saw in 2020 that guy made 4.1 billion. Obviously, he exploited market inefficiency. So, market is inefficient. You have additional cost.
So then he would have had to pay tax on 4.1 billion. No, sir.
Yeah, you'd have paid taxes, yes. But what if he funded all that money in Bill and Melinda Gates Foundation? If he donated all that money, then no zero, no taxes. Or even in Nita Ambani Foundation, if he puts all that money, there won't be any taxes.
Okay.
What he will then what is his responsibility? He will have to spend 5% of his total earning on social projects. So, what will be that social project? Providing ambulance services or providing hospitals to the needy. So, he will open a hospital out of that and earn profit from that also. That's how these super rich people have become rich. You pay 50% of your income as taxes and they pay zero. So obviously they will be rich. If they pay the same tax rate that you are paying, they would also be in the middle class. They won't be rich.
Okay, sir.
So that is what the government is doing. Okay, so let's go for hedge fund investment firms. So this is an investment firm means who can invest. Uh, is set up as a private investment partnership. Oh, this information is after the question. Come on. This should have been before the question. Okay. Because this question was asked, no, that
Yes.
these are private in partnership, either onshore or in a tax advantage offshore location. So they are private. Let's go to the figure and where it is this summary. Normally, the fund structures are incorporated as perpetual legal entities, but in reality, the hedge funds close if they are not making money and they are liquidated on a regular basis. So if they lost money, then they will be liquidated. Mm, Direct hedge fund investment firm. The common hedge fund firm is master feeder structure. The master feeder structure is set up for optimum tax efficiency, means they will save the taxes and consist of an offshore feeder fund and onshore feeder fund, means they will open account in Cayman Island as well, both feeding into a master fund that invests the capital based on its contractual partnership agreement. So both funds will be putting money and depending upon what the contract is. So here is the structure of the in the graph. So this one is fund LLC was opened. So master fund contains what? LLC is funded from onshore, means from USA or India. And then the TED fund, this one was TED fund, so it is USA. And tax exempt and deferred investors. This one is another fund.
So they themselves are teaching us how to do tax evasion legally.
Yes. How to do tax evasion or avoidance. Tax avoidance would be the better word because evasion is illegal. Avoidance is illegal.
Avoidance is legal. Okay.
Yeah, so they are doing tax avoidance. Then they put this money in the Cayman Fund LDC, and this one is offshore. So on this, US government cannot tax. So whatever return they are earning on Cayman fund, it is within the tax jurisdiction of Cayman Island, and there is no tax in Cayman Island. So both these combine master fund, and then that master fund is building the investment fund. So this investment fund is giving money to hedge fund managers. So normally it has been 220 fee, means 2% of AUM and 20% performance based. But now some of the newer funds are offered with a fee of 1 or 30, means 1% of AUM or 30% of performance fee, where the manager receives the greater of a 1% management fee or an incentive fee of 30%. So whichever becomes greater, uh, he will receive that fund of the funds alpha and outperformance against a benchmark. So outperformance against a benchmark instead of a performance fee based into total. So means he will have to outperform some benchmark, means hard hurdle rate. So this
Oh,
30% will apply with a hard hurdle rate, because that outperformance against a benchmark means benchmark will have some return, that will be the hurdle return. And so it should be hard hurdle rate. Okay, then hedge funds, apart from partnership agreement, they also use side letters to address a specific legal, regulatory, tax, operational, and reporting requirement to investors. So side letter gives them additional options. For that, they don't need to cancel the beginning agreement, but with side letter, they get a lot of flexibility to change the agreement as per situation.
oh, sir.
So
We had seen
we have
after
discussed.
the LPA, they can use a side letter to change the agreement.
Yes, yeah, we had studied this side letter earlier also. Okay, so then for larger investors, the hedge fund structure could be a separately managed account, and this one is an important concept. So it can be asked in job interview also. I was asked this, what is SMA, separately managed account, and it can be in the CFA exam also. So you should be, you should not forget this. So here is what it is. So there are separate investment accounts. These separately managed accounts are separate investment accounts within the hedge fund. Means one is a hedge fund, and then they will have a separate account in that hedge fund over which the investor retains more influence. Hedge fund manager has low influence. Investor has more influence for separately managed account. And now how? So in the case of fund of one structure, means it is only one structure hedge fund, then the hedge fund is created for one investor, and that investor is very big, means institutional investor. And in the case of separately managed accounts, the investor creates his or her own investment vehicle, and the underlying assets are held and registered in the name of the investor. So this separately managed account will be invested in the name of the investor. So the hedge fund manager cannot do fraud with this fund because it is not in his name. However, day-to-day management of the account is delegated to the hedge fund manager. What do you mean by day-to-day management? Because in hedge fund manager is getting information. So this guy, the investor, will tell invest 20% in equities, 10% in foreign currency, 10% in real estate, and that way he has given the broad policy. The hedge fund manager cannot do that, cannot change that. What he can do that, he will say, today this equity is lower, let's buy this. So he will do this day-to-day management, or he will say that, oh, this equity is going to fall tomorrow, sell it today. So that kind of job, day-to-day management of the account, is delegated to the hedge fund manager. So what he will do, if he sold the equity from this 20%, he will have to buy another equity to complete that to 20%. So that's why
Okay.
the separately managed accounts uh, give very little freedom to the hedge fund manager, only for day to day. and they monitor also on daily basis. So these structure may require additional agreement and service providers to operate efficiently and seamlessly. So separately managed accounts, the investor has the control, it is in his name. So what here is the example. So this investor is this one. He is putting asset control, means where to invest his money, which asset classes. Then governance. He will also say when you will report me and how much you can sell in a day. All those are governance. Monitoring. You will give me the report at the end of every day or next day or after a week definitely. That is the monetary. And risk management is also by the investor because he is diversifying his portfolio. So he may keep beta, or if it is long short, then he may eliminate beta to zero. And he can say that, yeah, it is market neutral, means beta is equal to zero. So that investor will decide, not the hedge fund manager. And then these are managed account segregated portfolio. So his account will be in his name. And so it will be segregated portfolio from all other portfolio of the hedge fund manager. So what does
He if the whole fund gets a huge return, then he is not exposed to that, no, sir.
no, he's not exposed to that because he will get as per his investment.
Okay.
Yeah, and if it loses also, then also he's not responsible for that. Means he's not exposed to that loss also. So hedge fund manager has only investment philosophy, investment process means which when to buy, when to sell. Governance also he will have discussion with this, and trading and operation. Yeah, this uh, at what price to sell or what how to sell those kinds of things. Monitoring and reporting that hedge fund manager will give to the managed account. What about third party service provider? Prime broker. Prime broker means who gives loans. That okay, margin loans. Then custodian, he keeps all the securities in his building. And then accounting and administration, yeah, the third party will give the report as well. And legal tax and compliance, they will also deposit taxes on your behalf. They will cut taxes on your behalf. So that is what third party. So that is how separately managed accounts, separately managed hedge fund investment account. The investor has full control because these four are risk management, he is controlling, where to invest, he is controlling, how will be the governance reporting, he is controlling, and he is monitoring also that whether you are deviating from his stated objective or not. So that way, separately managed accounts, the investor has more power than the hedge fund manager. So, hence the overall motivation of the manager for okay. So you said that what if there is a big gain? And yeah, the separately managed account will not be exposed to that. And the overall motivation of the manager for investment performance could be reduced. Means the hedge fund manager won't be so motivated to give a performance report, to earn performance report from this guy. So his incentive would be reduced. So structuring in favor of incentive, he can mitigate this problem. So this separately managed account, investor can provide incentive fee. That is what it is telling. Means can structure in favor of incentive fee. So that was direct, means separately managed account direct. The investor is directly managing most of the indirect hedge fund investment form means invest in a fund of funds. To make a hedge fund exposure more accessible to a smaller institutional and larger retail investors or those who may lack specialized skills in managing certain assets. Now, what do they do? It is best vehicle is fund of hedge funds approach, which is managed by portfolio of hedge funds. So he pays twice the fees. Those indirect investors firms they pay twice the fee. It does provide diversification benefit because it is a fund of funds. So different hedge funds are uh, are taking the money and they are giving the return. So that way definitely there is diversification benefit and they pay double fee. they have greater liquidity. Greater liquidity in funds of funds may result in weaker performance due to fund redemption in times of market turmoil. So yes, so there is higher liquidity, but higher liquidity means the return will be lower because liquidity premium itself increases the return. Hmm. So the fund of hedge fund manager, well, he will do the due diligence, means which hedge fund is going to give the best return. That is due diligence. Must monitor both absolute and relative performance, means absolute return is coming 10%, 12%, but relatively is it at the top, bottom, or in the middle? So if 12% is in the bottom, he will simply withdraw money from that. So though absolute figure 12% is very good, but relatively it is at the bottom, then he will withdraw money. The fund of funds manager will withdraw money from that and invest in those who are giving more. So that is the job of funds manager, and he often is able to negotiate better redemption or fee terms than individual investor can. Means 1 or 30, that kind of fee instead of 2 or 20. Because in two, he will take the fee even if he didn't make money. But if he didn't make money in this 1 or 30, he can get only 1% of the fee. So this one is the example of a fund of funds hedge fund, and it tells us correlation between different funds. So how will the diversification be? Fundamental growth have 0.91 with fund of funds, means it is not providing much diversification, but yeah, whatever
So
the performance
all
of
of these
fund of
are
funds,
indirect investment. Okay.
all these
In
are
this
indirect
fund of
investment,
funds,
yes.
everything is okay.
Yeah. So here, this one has short bias as the maximum diversification because
As
it is
usual.
minus 0.84.
Okay.
So that way, he will have invested in all these and he can get a better risk adjusted return. So because what is this? This one is the highest correlation between fund of fund return is with fundamental growth, and the lowest is with short bias funds. So that way, this one is diversified investment. Mm. So now ETFs have also started copying hedge funds, but since they have much less freedom than ETFs, their performance is not so high as that of hedge fund managers. Even though they are copying hedge funds, but still their performance is much lower. And here is the liquidity. Liquidity spectrum of various investment alternatives. So least liquid is limited partnership, which are hedge funds and private equity. Separately managed accounts are more liquid because the investor is controlling the fund, but still, if the hedge fund manager has invested in illiquid assets, he cannot get money on all. He still have to go through gate or this lockup period. Then closed-end funds, these are mutual funds mostly, closed-end, and open mutual funds are most liquid. So closed-end funds can be mutual funds, they can be REITs, they can be private equity funds also, or funds of hedge fund. All these are, these can be, not that they are, they can be closed-end funds. Means closed-end funds means no new investor. During the period, whatever investors came, only they will remain. So that is closed-end funds. Then mutual funds, we know very well, and exchange-traded funds. So exchange-traded funds are most liquid. Well, it is here just the explanation. So we saw that those ETFs who are trying to copy hedge funds, they have given better return than before, but not close to hedge funds. And because they're highly regulated, and then so they have to provide reports regularly, the regulation fees also they have to give. So all these have reduced the earnings of ETF when compared with the hedge funds of the same strategy. Okay, read question. Hmm. Oh, there are the yes.
Choose the correct statements regarding benefits of a master fee structure. It allows investors in taxable jurisdictions to invest in an offshore hedge without any tax liability. True. Uh, Pooling funds from
So
offshore.
without any tax liability, okay, means yeah, in some offshore, yes. In offshore there is no tax liability, yes. But onshore part there will be, yeah, true.
Yes.
Okay.
Pooling funds from offshore and onshore funds creates economies of scale.
Yeah, this is true
Yes.
because more fund is there, so
More
there
fun-
will be economies of scale, yes.
This structure allows hedge funds to accept funding from global investors with relative ease. Yes, sir.
Very good. That's true too.
Many regional regulatory requirements can be avoided by such a structure. True.
Yes,
Yes, sir.
because they are investing in different countries, so they may say that well, I should be free because I am governed by there also. So all are true. And the regarding let's see, is it B, C, D are correct? Oh, A is not correct. What is okay? I hadn't read it carefully. It allows investors in taxable. Oh, that's why I had
Oh, okay, okay,
read.
okay, okay. If they are in taxable, okay, they will be taxed.
Yeah, they
Oh,
have
okay,
to
okay.
pay taxes on in their jury. Yeah, that's why I had raised this issue.
Okay, sir. Okay, okay.
Yes,
Oh.
means in the offshore part, which is tax exempt, there they will not pay, but onshore they have to.
Onshore, okay, okay.
Yeah, so
Um, which of the following statements about SMS is least accurate? SMS are
this is
preferred
a
choice of
separately managed accounts. Yeah.
account. Yes, sir.
Okay.
Are preferred choice of high net worth investors with specific investment mandates because they are highly customizable. True.
Okay. Very good. This one is true.
SMS
Yeah.
provide better transparency for investors than other fund structures. True.
Provide better. Yes, definitely it is
Okay.
true. Yes.
SMS are characterized by simpler fee structures.
No,
No, sir. No, sir.
this is not true. It is complex. Yeah. So okay. What about D? Is that
The
correct? Or
potential of conflict of interest exists for SMAs since managers are not personally invested. True, sir.
so only C.
Which of the following is least likely an investor objective that would help inform the choice of a specific fund structure? Reduce tax leakage and enhance returns by efficient tax planning. It's least likely an investor objective that would help
Least likely an investor objective. Oh, investor objective. Okay.
object.
So each objective to reduce taxes. So this one is correct.
Yes.
And enhance return by efficient tax planning. Yeah, this one is correct. Investor wants to have that. Yes.
Ensure an appropriate amount of investor control on companies.
This one is also correct because in SMA,
SMA, sir, not in
yeah.
general.
Yeah, so which of the following is least likely an investor objective? SMA is also an investor, no.
Okay.
So fund structure that would help inform the choice of a
Choice
specific.
of.
Yeah, so SMA will also have this, no?
Oh, yes.
Means he will choose that one which
Yes.
either typical or yeah, so he can choose
Okay, sir.
maximize the net. Well, maximize is it is not the objective. Means. Maximizing is what? It is not possible actually. Nobody can maximize. They earn some satisfactory return that they can survive. Maximization is actually, even in economics, maximization of profit is rarely achieved. Means
Minimizing
monopolist
losses.
also doesn't maximize the profit, even though he has the power to decide either price or quantity. Now, which one will maximize the revenue profit? He doesn't know that. So C doesn't look possible. Okay, what about D? Well, yeah, D is the objective. Reducing regulatory is quite possible. Means he will have accountants and he will say that this is hedge fund. So regulatory and compliance. This one is also the. So looks like C is not achievable. Maximize the material. What is the? Yeah, do you agree with C or not?
Sir. Minimizing the risk would be the better objective.
Yeah, so it is telling the least likely, no. So yeah, minimizing the risk would have been better, yeah, because risk tolerance. So and risk is measurable through a standard deviation. But at which point portfolio will maximize the return, it is undefined.
Undefined.
Risk
Yes.
is defined. Standard deviation we calculate and risk is defined, yes. Yes, C is correct answer.
Identify the investment structure most appropriate for the investor.
Okay. I think you can easily do it, yeah. What should I type? involve.
High net worth investor who requires tax efficient investment channels with a high degree of control when SMA, sir. B.
SMA, very good. SMA, yeah, B.
Uh,
Okay.
an institutional investor intending to invest in commodity markets, manage futures.
Yeah, it is managed. Okay, so this one is B and
A, C.
B, A, C. Okay. A, what is it? B, A. Okay, so I don't even need to type C, but hmm, yeah, you are correct. This one is easy question, B, A, C. Okay, hedge fund and investor risk return. So we saw that the return was higher. Okay, we will look at the data. We have already. Okay, so how do the hedge funds manage risk return? They earn total alpha, and most of them, those who are market neutral, they have beta zero. So beta is lower part. So here is the picture, and
Can you zoom a bit, sir?
okay, I can zoom it like that. Can make it big. Okay.
Ah,
Now,
okay.
this one is best here. So this picture tells us that here is alpha and here is beta. So hedge fund strategies emphasize idiosyncratic risk because they want to take double beta. And when they take double alpha. And when they take double alpha means beta by definition will be zero. Because one alpha is coming from short, another is from long. So if they are making market neutral double alpha means beta is zero. So that's why their return is highest hedge fund returns. They emphasize more on idiosyncratic risk because they are skilled and they also want to exploit market inefficiencies. So if they invest in the entire market, then what? They are like passive investors. So their skill is of no use. If they become passive investors, sector style and market. So this one is beta, this side is beta. So their sources of return approach is emphasize idiosyncratic risk, diversify sector and mitigate market risk. Means these three are the sources of return. So what does this heading is this? Comparing traditional and hedge fund portfolio sources of return. So this one is traditional return. Traditional people emphasize on diversification, so they invest in all the sectors of the market, and that way their beta will be 1. Here, the beta will be 0. So the beta of hedge fund is close to 0, and idiosyncratic risk is highest. While these guys, traditional funds, they reduce idiosyncratic risk. So that is what the summary of this part is. And there is nothing more to discuss, so let's go down.
So alpha of traditional funds is close to zero, whereas beta
Zero,
of
yes.
uh,
Yeah, close to zero.
yes, sir.
Means, of course, they have equity researcher whose job is to find alpha. But when they are diversifying in the market, and they're only doing long, so they cannot get more than single alpha, first of all.
Okay.
And they will not be researching all the company because they have to pay to the equity researcher. So it is cost. Researching is cost as well. So what these ETFs and mutual funds do, they will simply invest in highly researched companies like Apple, Microsoft. These are analyzed by many analysts. So what they will do, they will not have their own analyst. They will simply invest in these companies because they are highly researched, so they don't expect to get any alpha. So if they are not going to get any alpha, then why pay equity researcher? So that way they do that. So alpha is quite small for mutual funds. And for hedge funds, alpha is the main source of return. Market beta. So broad market beta that can be realized using market index fund. Yeah, market index funds and ETFs means mutual funds and ETF. They rely on market beta, and due to selection, okay, nothing to learn. Let's go down. We have already discussed these. So Hedge funds are due to systematic and idiosyncratic alternative risk factors not considered by the model. So hedge funds earn both systematic and idiosyncratic, but mostly not considered by the model. Means alternate, not okay. So whose model? What does this want to tell? This doesn't say that traditional asset pricing models are incorrect. Okay. No, traditional asset pricing models are not incorrect. Dividend discount model works. P by E multiple also works. So they are not correct. Though hedge funds don't choose that traditional strategy. Selection, okay. So about hedge fund performance, we saw that selection bias was an issue. Backfill bias was another issue. So selection bias, okay, yeah, yes. Let me explain you detail because you know backfill and survivor. So what is written about selection bias? Individual funds are allocated to strategy peer groups in an inconsistent manner. So there is no consistent manner of selection. They simply choose in an inconsistent manner. What? Sometimes based on prospectus, sometimes based on historical style analysis, means whether it was value or growth or mixed, and sometimes using a combination of approaches, means both value and growth, and cash of which adds and compounds bias. Okay, each of which adds and compounds bias. Since they are using the past style, so it can cause selection bias and another selection bias. Some index providers impose requirement on AUM, assets under management, then vintage year. Which year did they invest? Was that a normal or was that 2008-9? And whether the hedge fund is open to new investors. So whether it is closed or new investors can be partners. So all these are causing selection bias. Means this is not random selection. So if it is not a random selection, since vintage year decides, then opening to new partner AUM size, and then their style, past style, all these are causing selection bias. Okay, then another problem with the data of hedge funds is that they are published with a delay, normally a time lag of 4 weeks or 1 month. So since these indexes are not in, you can invest in ETF, you can invest in SPY 500, you can invest in Nifty 50, but you cannot invest in hedge fund indexes, and so they are illiquid. And hence their performance may be difficult to measure. Backfill bias we have already done. Okay, and then hedge fund indexes are not weighted, means each hedge fund received an equal index weighting in the performance peer group. So some hedge fund may be worth 10 billion, others may be worth only half billion, but they will get equal weighting. And that is a problem, like the problem that Dow faces, where only price is the weighting. So market capital free float weighted was considered the best weighting method. Yeah, as we had discussed earlier in indexes, that free float market cap was the best one. Okay, hedge fund investment risk and return. Let's go to the simply data, and then of course they diversify risk, and so they have risk advantage. Let's see. So a standard deviation tells us the risk. Yeah. So for 24 years, from 1990 to 2014, fund of funds return is 7.2%. What did global stocks give? They gave 6.9%. So in 24 hours, the return from fund of funds means the return after, is it before fee or after fee? Historical risk return, correct hedge fund and other investment. Okay, if it is after fee, then it is even better. But anyway, so it has given 7.2%. Let's see, is it after fee or before fee? Hedge fund certainly offered added value to institutional investors as a portfolio diversification agent in the time period. So the added as diversification agent means their correlation must have been low with global stocks and global bonds. So let's see. First of all, they performed better than both, and but in the last 5 years before COVID, their performance was much less, 2.48%, while global stock gave 10.41%. But this is a small period, 15 only 5 years. So the sample size is small, so this may have problem. But in the last 5 years, this was the performance of global stock was highest, but still they performed better than global bonds. So what does it mean? These fund of funds can be used for diversification benefit for global bonds. Means we will not invest 40% in global bonds, but only 10-15% and more in hedge fund because let's see their correlation. So what is the correlation? Fund of funds correlation was how much? 0.56. So some diversification benefit, but with bonds, the correlation is very low, just 7%. And here, the correlation is only 3%. So here, this shows that this part is giving diversification with bonds. Means we can have bonds as well as hedge funds because both are unrelated. So adding fund of funds instead of global bonds, that reduces the risk because of diversification benefit. And then what is the risk actually? So where is the risk standard deviation? Let me see. There must be a standard deviation somewhere, no? This one is fund of funds annualized return. Here is this. This one is volatility. So who is more volatile? This one is the risk. So the risk is only 6%, which is close to bond risk. But the return was higher. It was 7.2, and bonds gave a return of only 6.3. So that way, hedge funds, adding hedge funds, added value. The risk adjusted return was more. Then for the last 5 years, 2015-19, the standard deviation is very low, just 1.8%, even lower than global bonds. Then why not replace global bonds with hedge funds? That will reduce this risk. Okay, that is what it has been written here, nothing more. And this one is another data, and that gives us risk and return of selected hedge fund strategies. Selected means those short buyers, long buyers, fund of funds, and then we had listed securities. So let's say how does that work? Return and risk of
Sir,
selected.
in exam, if they don't give the graphs, it's a bit difficult to remember which one is.
Yeah,
Uh,
they will give you the graph.
oh.
But you can remember that hedge funds
So
are,
like
yeah,
certain,
they are
if it's short bias, we can know that it's the most diversified, and
very good.
growth is the least diversified. That part is general that we can remember,
Yeah,
sir.
that is
But
what they will ask in the
oh,
exam.
okay,
They
okay.
will not ask you more detail. So here the book had written a major error, so that's why I had highlighted in red. So another measure is to analyze the benefit from investing in hedge fund is through coefficient of variation. And the definition of coefficient of variation is a standard deviation by S bar. You remember that?
Yes, sir.
Coefficient is sigma by S bar, X bar. So the coefficient of variation can be thought as the price of return in terms of risk. Means higher the same return and higher the risk, that will give a higher coefficient of variation. So risk is the price of return or the relative return adjusted for risk, means risk-based return, risk-adjusted return. So what should be? If coefficient of variation is higher, that means same return, more standard deviation.
Yes, sir.
Okay. Now the book has written a higher coefficient of variation provides greater return. No, it provides a smaller return. No, because same return and higher coefficient, higher standard deviation for the same amount of risk. No, it is telling the higher coefficient of variation provides greater return for the same amount of risk. First of all, if the risk is same, means S is fixed, then the coefficient variation means higher return means higher X bar because return is X bar. So,
Okay.
yeah, so that will be lower coefficient of variation because denominator is bigger. Numerator
Oh,
same
no, it's
amount.
fixed. Okay, numerator is fixed. Okay, okay,
Yeah,
okay.
so denominator is bigger. Hence, the coefficient variation will be smaller. Do
Okay,
you
sir.
believe? Yeah,
Yes, sir. Yes, sir.
you understand that? So here the book has been wrong. Means this author is not very good in mathematics. Diversification of hedge fund benefits. So let's look at the diversification benefit. Okay, it has rather reduced. So what was the diversification benefit? We saw that from 2001 to 21, we already studied that they provided diversification benefit because R was only 0.51 and with bonds it was close to zero correlation. Here, another period that was from 1990 to 2014. This one is from 2001 to 21, more recent. So here, the hedge funds are correlated with SP 0.82. Means there has been higher correlation with the broad market index of hedge funds, and maybe because many hedge fund investors change, many hedge fund managers change their strategy, but the correlation with bond, invested grade bond is quite low. It is 0.10. What about these bonds had with S&P? They had minus 0.06. So in this case, in the recent period, the bonds provided better diversification than the hedge funds because this one correlation is minus 0.06 with equities. So if we take the period from 2001 to 21, which had two major market disruptions. One was COVID, and the another was 2008-9 crisis. So that's why that might be the factor. Means the COVID. The COVID period, which includes 2021, might have been the reason for changing the correlation of hedge funds with equity market. Okay, so what is the summary? The summary, oh, it is hedge funds have a fairly high correlation with equities, means 0.82, and low correlation with investment grade bonds, which is only 0.10. Because with investment grade bonds, hedge funds have only 0.10. So they can diversify, means replace bonds with hedge funds, because the return of hedge funds is definitely more than that of bonds. Okay, so let's see this question set. Hmm.
Selecting investment trades with high idiosyncratic risk is most likely associated with the management of which type of fund?
Yeah, so
High.
EPS means beta zero
Uh,
and alpha double.
yes, sir. Alpha double would be long or short equity hedge fund.
Very good. See,
Hedge funds are not obliged to report their performance to the public. Many do, however, to attract additional investors. Hedge funds benchmarks and indexes are created using the reported data. Which of the following is least likely a bias that hedge fund investors should be aware of when evaluating the performance of hedge fund benchmarks and indexes? Survivorship bias, they should be aware of that.
yeah,
Self-reporting bias. Hedge funds have the freedom to not report their performance and will be the ones that report.
yeah, been selection bias. Yeah,
Yes, sir. Societal bias is related to the purpose. No, sir. Societal bias.
yeah, we never studied societal.
Yes, An investor wants to invest in a diversified hedge fund that minimizes the return correlation with traditional asset classes, but would prefer the fund to be more liquid and transparent while
Okay, so here
minimizing
is the thing to need. It is asking for more liquid
liquid
and transparent while minimizing the leverage obtained by borrowing or shorting. Okay,
fund of funds, sir.
fund of funds. No, manage, more liquid futures. Come on, we have discussed it. That futures are the most liquid and their prices are, I should have seen the,
Oh, okay, sir. Okay, fund of funds will have the lock-in period and all. Okay, okay,
yeah,
okay.
they will be liquid, but managed futures
Uh,
are most
most
liquid.
liquid. Okay, sir. Okay, okay, okay.
Yeah, because they are futures can be sold easily, no?
Okay, okay,
Futures
okay,
are
okay.
highly liquid, means most liquid. They are as liquid as cash. So, okay. Then we should have read it more carefully. Means I don't. The investor wants to invest in a diversified hedge fund that minimizes the return correlation with traditional assets. Yeah, these are commodity futures. So with equities and bonds, they have less relation. CTAs. Not all CTAs are managed. CTAs are futures, yes. Yeah, CTAs. But would prefer the fund to be more liquid and transparent. Yeah, transparent it is because we can easily see the price of the futures and we can easily see the spot price. So there is no opaque. So managed futures are most transparent and most liquid also. And well, since they are futures, so there is no leverage by borrowing, and there is no shorting also. So what would be the most appropriate hedge fund investor can choose? Okay. Anyway, okay. We should go in the beginning, and then we will. Okay, or we can solve here and go in the beginning later. Okay. Okay. Let's solve this here. Then we will go in the beginning.
Choose the false statement about hedge funds. Well, traditional fund managers charge mainly a management fee. Hedge fund managers charge both management and performance-based incentive fee. True.
Yes.
Redemption of funds from hedge fund prior to its liquidation is very hard due to initial lock of prudent specific terms of redemption. True.
Very good. So C must
Individual,
be wrong. Huh?
individual investors cannot invest in hedge funds and only in yes,
No,
sir.
high net worth individuals can invest. So yes, C is the answer. Yes. It falls because high net worth individuals can invest, or those who are classified. Yes.
A fundamental long or short fund manager is evaluating a specific securities to build a portfolio position. Which are the following is a strategy that the manager least likely adopt. Long
Fundamental long short hedge fund manager is evaluating a specific securities to build a portfolio. So it's long and short. So beta should have, okay.
yes, sir. Long securities that have an upside potential relative to the current price. He will do that.
Yes.
Short sectors with macro trends negatively impacting the company. Macro trends.
Negatively impact the company and short trends with short sectors with macro trends negatively impact.
That is
Okay.
the macro hedge fund, sir. So
That is macro hedge fund, yeah. Okay, let's see the C. What is the
long
C?
sector, long securities that trade at significant discount, expecting an increased valuation in case of bankruptcy.
No, long securities are traded at a significant discount, means convertible bonds. Expecting, what is the question? A fundamental, oh, it is long short. No. So he will not invest in bond. Yeah, he will do the short, he will do the long, he will not invest in bond, convertible bond. So this becomes different because this is a
Sir,
fundamental.
then what is short sectors? Sir? It should be.
Short sector means he will short some sector like industry is not going to grow. Then he would invest in IT, which is going to grow.
Oh, okay, okay,
That's what the shorting the entire sector.
okay, okay, okay.
So long security that trade at a significant discount. These are
Oh, yeah,
convertible bonds actually.
okay, convertible. Okay, okay.
So
See.
C should be okay. Let's see. A fundamental. Let me read the question again because I'm not very clear. A fundamental long-short hedge fund manager is evaluating specific securities to build a portfolio. Means he will study equities, fundamental long-short. Which of the following is the strategy would list? Oh, yeah, then long securities that trade at significant discount, mm, expecting an increased valuation in case of bankruptcy. No, In the case of bankruptcy, equities will be zero, and bonds may go up. So this is not long short. So yeah, she is the correct answer. Long short will do only long and short, so not she. Question number 3.
Which of the following fund structures is most likely to be suitable for an institutional hedge fund investor that seeks a highly customizable offering with negotiable fees?
Yeah, so highly customizable means
Separately managed.
separately managed accounts. Yes, this one was easy for you.
Sir, I think A structures. I think so. Two answers.
Fund structures is most likely to be suitable. Which of the following fund structure? Yeah, means out of these four fund
Are there more than
these
one
are
answer?
four fund structures: separately managed account, commingled hedge fund, mutual fund, funds of funds. All these are four structures, four kinds of a of
Okay, okay,
fund.
okay. Sir, I thought like
Structure means kinds. Yeah.
okay. So one
Uh,
answer.
yes, only one answer. That is highly customizable offering with negotiable fees with separately managed accounts. Okay, question number 4.
Which of the following parties is responsible for the portfolio management of a fund of hedge funds? General partner.
General partner. Yes.
Which of the following best explains why it is unlikely a poor performing hedge fund would be added to an index? Unlikely a poor performing hedge fund.
Could be added. So selection bias. She won't be selected.
Sir, what is the meaning of the sentences? Unlikely a poor performing.
Okay, which of the following best explains that it is unlikely means will not be
Will
selected.
not be selected. A poor
Means
performing hedge fund
hedge fund will not be selected to the index.
would. Uh, okay, sir, that is not a bias, no, sir. Like that is a good thing
No, that
only.
is a bias. No means it didn't select it. So all those who have been selected because they performed good. So
Okay, okay. Those
that gives the selection
selection
bias.
bias. Okay, okay.
Yes.
The strategy that identifies opportunities for future merger, bankruptcy, or spin-offs and seeks profit from pricing inefficiencies is known as this merger is event driven, no, sir.
Event driven, yes. It
Event-driven.
was event driven because opportunistic is relative value is not because it was about credit rating and
All those
yes.
bond.
And opportunistic was one was that managed futures, no, and market. Opportunistic was what?
Exploiting any inefficiencies only, sir.
Inefficiency, yes. So, no, but was it one was this active?
The
Uh,
opportunities was the managed future and macro strategy.
Macros, yes.
Okay.
Macros and these CTS, they were
CDS,
opportunistic. Yes,
opportunity.
managed futures, yes. You see, the question came on CTH.
Uh,
Means and carelessly we made the mistake. Most liquid, they are the most liquid ones, yes, and most transparent also.
okay, sir.
Yeah. Question number 7.
A money manager was reviewing the automobile sector and identified that the stock of GM is relatively overvalued compared to Ford. A money manager purchases 100 shares of Ford and shorts 150 shares of GM. It turned out that the manager's perception was right. At the end of the quarter, she unwinds both the positions, making a profit on both the positions. Oh, sorry, it is equity long or short.
Very good. This question was easy. So only 7. No, I don't think there is any other question. Yes, okay. So how did we answer? Let's see. C, C, A, B, C, C, A, B, C, A, A, C, C, A, B, C, A, A, C, C, A, B, C, A. Very good. You answered all the 7 correctly. Now let's go to the top. I think it is on page 157. Yeah, question number 1.
Which statements about hedge funds is most accurate? Hedge funds are investment products offered to the
No,
public.
they are not product
Uh,
offered.
for,
Leave it. Okay. B. Yeah.
it's most accurate. Hedge funds are
Yeah, so
benchmarked.
A is wrong. I mean,
Is
they are
wrong.
not product, they are
They're not a
investment.
product. Hedge funds are benchmarked on index or sector. False. B is also false.
Yeah, so C must be correct.
C is
Yeah,
hedge funds are privately. Yes, sir.
yes, C is the correct answer. Product is what? This derivative is a
Yeah,
product.
derivatives.
Yeah, his fund is not a product. Hmm.
Which of the following statements about relative value strategies is least accurate? Relative value. Okay. Relative value strategies seek to profit from price or return discrepancy between securities based on short-term relationship. Short-term. Yes, sir. We
Yeah,
had
this
two
can
or
be
false.
relative valuation seek to profit from a price or return discrepancy between securities based on short-term. That's correct. This can be correct. But let's see B. Whatever. Let's read all the options.
Yes, sir. Relative value funds are inherently structured to minimize net market risk and credit risk.
No,
No, there is nothing
that
in
only
it.
means okay. C.
The investments made under a relative value strategy are all within a single asset class or sector using assets with sufficient price.
No, it doesn't have to be single. It can be many. So A is the correct answer.
Sir,
A.
least accurate. Sir.
Which of the following is least accurate? Oh, which is wrong? Oh, so this one is actually correct. Really seek to profit from a price
Yes,
of
sir, that is also correct, sir.
that one is correct. Least accurate C is the answer then. Relative value funds are inherently structured to minimize net. No, they don't minimize net risk. So B is wrong. Let's see. What about C? The investment made under a relative value strategy are all within a single asset class or sector using assets with a sufficient price differential to arbitrage their movement to equilibrium pricing.
Yes, sir. If it's bond, we use only bond. If it's equity, we use the delta hedging. We use that only, not sir.
Okay, so only B is wrong, yeah?
B is.
B is wrong.
Or sir, is delta hedging minimize net market and credit risk? But delta hedging is also. No, sir. Then
No, it
B.
doesn't mean yes. C is
Oh,
correct.
B.
We messed up. Why is C correct? Let's see. Because it is the least accurate. This is not the answer.
So how is this an answer?
Relative valuation often involve investment in different. Yeah, that is what I was saying. That it is not restricted to single asset class. That you so I said no. That no.
Okay, yes, sir. Because delta itself is a change in price of call by change in price of stock. So
Yes.
you have two different asset classes over there.
Yeah. You
Okay.
have one is derivative and another is
Oh,
the equity or
equity also.
yeah.
Okay.
So it is not restricting. Okay. We should have, yeah, if you would have read it more, then would have answered it correctly. Anyway, question number 3.
Which of the following statement is least accurate about hedge funds? Merger or arbitrage strategies generally assume that an acquirer will be overpaying for the target. No
This
such.
is correct. No, overpaying for the target is correct. Then only he buys, Then only he buys the stock of company B because he will be overpaying, so its price will go up.
That is just paying, no, sir. How is it overpaying?
Overpaying means, yeah, he will not pay the fair price because he is strategically buying that. He is acquiring, so why will he be sold unless the investors are paid more? So since this acquirer is strategically buying means it values more the security than what market values.
Oh,
So
okay.
that's why he will overpay. Because market value is fairly priced, and since he is strategically buying means this guy has some extra return, some synergy, or some higher marginal utility from the purchase of that company. So he will be overpaying for the target.
Okay, sir. Okay.
Yeah. Otherwise, why will this target be sold? The board of directors will not approve. They will say we will not sell you. So in that case, unless you pay more, so he will overpay. Okay, B.
Event-driven hedge funds flourish in a stable market environment where
No,
they don't.
they in unstable market. B looks wrong.
An active
because
strategy expects to realize higher returns due to manager being more effective in driving the corporate policies or strategic direction.
an activist strategy, yeah, he's correct, because once he becomes he buys stocks, and then activist is expected to realize higher return due to the manager being more effective in driving the corporate policies or strategy direction of the investor. So he becomes the manager, and when he becomes, he will drive he will remove the efficiencies and bring more profit. So she is also correct, but which manager is he talking? The investor becomes the
Ah,
manager.
yes, sir. That part is not clear now, sir.
Yeah, that
Already
is because
existing manager, or is it the
yeah, like
activist?
Elon Musk, you had talked about who Elon Musk
Ah,
and Twitter.
yes, sir.
Now Elon Musk is the active manager of that,
Hmm.
of Twitter. So, but B is definitely wrong because event-driven hedge fund flourish in a stable market. No, the event itself brings instability in the market. So let's see what is the answer. B should be the answer. Do you believe in B?
Oh, yes, sir. B, they flourish only in an unstable market.
Unstable market. Yes, B is correct. And
Uh,
this Elon Musk example
yeah.
of Twitter
But
means
the
he,
option is not correct, sir. Like you should
yeah,
have said
yeah, they should write
after
that
takeover.
investor should have, yeah, he should write that due to manager, no, investor as manager being more effective in driving. That would have been the correct answer. That means correct wording. Investor as manager, activist as manager means then, or due to the activist being more effective in driving. Had he, instead of manager, it should have been actually activist. Let me type it. This would have been the better word would have been activist. That would have been a better word for manager. Yeah, many people in USA, you have you don't have many people from non-English speaking countries, and they write this kind of English. Oh well, why not to keep it here? This activist that would be better. Okay, question number 4.
Yes, sir. Which of
Hmm?
the following is not a characteristic of hedge funds? Hedge funds are mostly liquid with latent trading possibilities. True.
Hmm.
Hedge fund managers use leverage, however, the overall risk is lower. Well, overall risk
Overall, this
uh,
means within the probably this can be
could be
wrong.
wrong. Okay.
Though hedge fund managers use liquidity, however, the overall risk is low. They say that it is lower because the leverage money will be used in different asset classes. Means they will invest in equities, bond, real estate, everywhere they will invest. So that way the portfolio risk can be lower. Mm, is not a characteristic. This one is possibly correct. They use leverage, this part is correct. Overall risk is lower. Oh well, standard deviation was lower. Yeah, we saw that standard deviation was lower, no, than equities. Do you remember that?
Oh, yes, sir. Yes, sir.
Yeah. So then B is correct.
Hedge funds are different asset class with a distinct. Uh,
They are
it is
not.
not an asset class.
They are not asset class. Yes. So C is wrong. Which one? Okay, let's see. For D, manager demand higher and have more discretionary. Yeah, D is also correct.
True.
So C looks to be wrong. Yes, C is. Hmm. So I think you can calculate this easily. Okay, let's go up. You can calculate this easily because it is the previous.
Yes,
Hmm.
sir. New hedge fund started operations with an initial amount of 100 million. The fund charges a management fee of 1.6% based on end of year value and performance fees of 18% on gross returns payable on the excess over a hurdle rate of 8% after fees.
Hmm.
The fund ended with 120 million. So,
So
okay.
120. So let's see
Uh,
this AUM. So A,
20%.
yeah, is equal to 0.2 times, sorry,
120.
1.2,
1.2 times.
120 times 120 times 1.6. So how much will this be? This will be 1.92
Yes, sir.
because 16 million, 1.92 million he took away.
Yes, sir.
And then performance fee. So PF is equal to 8% is the hurdle rate,
Hurdle rate. Yes, sir.
and he has all. So how much did he earn? 20%. No.
20%. 20
So this
into.
became 12%. 12 hurdle rate. Okay, let's put it 120 minus 108 because 100 became 108 after hurdle rate, and then minus 1.92 minus 1.92 because it is net of fees. No, and this times 0.18. This entire times 0.18 because it is the 18% performance fee. So how much will this be? Times
120 minus 108 minus 1.2. So 1.814.
1.814.
814.
Okay, 81. So let's add both these and deduct from 20. So total, okay, let me put total fee. Total fee is equal to how much? 1.92 plus 1, 2.92 and 81. So 3.72.
16.
3.62. 3.62, no? 9 and
Yes,
7 is 6. So 3 point, how much? It is 1.81. So 3.72, yes. 3.72 million, 72 he took away. So what did the investor get? So two investors. So investors, sorry, I pressed wrong. Investors share. Investors share is equal to 120 minus 3.72, which is equal to 116.28. 116.28% means, so he gets a 16.8 is the correct answer. Some typo error. So 16.2 A is the correct answer. So yeah, A is correct. 1.92, 10.08 millions of performance fee, 1.81. Yeah, we correct. It is correct.
yes, sir.
Both are correct. Then where is the problem?
20 minus 3.72 is 16.28. He has written as
Yeah, 16.3 should be not 16.38. This one should be 16.28. Let me type it correct. So actually, this is 16.28. 16.28%, not 38. It tells what total fee, which is equal to 3.72. So 20 minus. So the problem is here. It is 16 point, not this. This one is 16.28. Okay. And the book made a mistake. 16.2828 million. Okay. Now let's go to the next question. Okay, that's it. So we finished the chapter today. And how was this? Was this very interesting?
Yes, sir. One
Yeah,
of the most informative.
most informative. And you felt the smartness.
Yes, sir. Yes, sir.
Okay, so we will study the last chapter tomorrow and we will finish this book. Okay,
Yes, sir. Okay.
good night.
Thank you, sir.